Welcome to The Psychology Code, Unlocking Forex Trading Mastery by A.T. Shiva. Whether you're a beginner or an experienced trader, this audiobook dives deep into the hidden mental forces that shape every decision you make in the Forex market. Trading isn't just about charts and numbers, it's a battle fought in the mind. In the next chapters, you'll discover how to decode your own psychological barriers, master emotional discipline, and develop the mindset that separates consistent winners from those trapped in endless cycles of loss and frustration. Prepare to unlock the secrets of trading psychology and transform the way you approach the market forever. Let's begin the journey to mastering the most powerful tool in Forex trading, your mind. The Psychology Code, Unlocking Forex Trading Mastery. Chapter 1. The Mind of a Trader. What separates successful traders from the rest? In the world of Forex trading, the difference between success and failure rarely comes down to who has the best indicators or the most sophisticated technical strategy. In reality, the core distinction lies in psychological discipline and mental resilience. Successful traders understand that markets are inherently uncertain and that no one can predict every move with accuracy. Rather than trying to control the market, they focus on controlling themselves. They develop a deep sense of self-awareness, recognizing how emotions like fear, greed, hope, and frustration can sabotage decision-making. Unlike the average trader who may be ruled by impulses, chasing trades, doubling down on losses, or abandoning plans mid-trade, a successful trader sticks to a well-defined strategy with unwavering discipline. They know that their edge doesn't lie in the outcome of any single trade, but in the consistent application of a proven process over time. Moreover, successful traders do not measure success solely in profits. They evaluate their performance based on execution. Did they follow their plan? Did they manage risk properly? Did they stay emotionally neutral regardless of the outcome? These questions form the foundation of their growth. They maintain a long-term perspective, understanding that drawdowns are part of the game and that setbacks are opportunities to learn and adapt. They also take accountability for their results, never blaming the market or external factors. In contrast, less experienced traders often look for someone or something to blame: brokers, news events, bad luck, anything to avoid facing the psychological challenges within themselves. Another key trait of successful traders is emotional detachment. They do not become overly excited by wins or crushed by losses. They treat each trade as just one of many, focusing on probabilities rather than certainties. This balanced emotional state allows them to avoid the roller coaster of overconfidence followed by panic that plagues so many retail traders. They also understand that trading is not about being right, it's about being profitable. They are humble enough to admit when they're wrong and disciplined enough to cut losses quickly rather than letting them spiral out of control. Ultimately, what separates the top 5% of traders from the rest is not their tools or their timing, but their mindset. They operate with discipline, patience, self-control, and a relentless commitment to self-improvement. They build routines, track their behavior, and work on themselves just as much as they work on their trading strategy. In Forex, as in life, mastery begins in the mind. And the traders who understand this are the ones who not only survive but thrive in the market. Part 1. The Mind of a Trader. The Role of Psychology in Trading versus Strategy. In the world of Forex trading, there is a common misconception that mastering the markets is simply a matter of discovering the right strategy. Many new traders spend months or even years hopping from one system to another, endlessly backtesting setups and obsessing over indicators in search of that elusive holy grail. However, the hard truth that most learn, often the hard way, is that trading success depends far more on mastering one's own mind than on finding the perfect method. While strategy provides the framework, psychology determines execution. And execution is where the battle is won or lost. To illustrate this, consider two traders using the exact same strategy. Both have the same entry and exit rules, the same risk parameters, and the same market conditions. Yet over time, their results may diverge dramatically. Why? The answer lies in how each trader handles emotions, discipline, and decision-making under pressure. One trader may execute flawlessly, accepting both wins and losses with emotional neutrality. The other may hesitate after a losing streak, hesitate to enter trades, move stop losses, or abandon the system altogether out of frustration or fear. The strategy itself hasn't changed, only the psychology behind it. This is why experienced traders often say things like, "A mediocre strategy with great discipline will outperform a great strategy with poor discipline." Forex trading is not a game of perfect knowledge, but a game of probabilities, repetition, and consistency. A strategy may only work 55% of the time, but if the trader can follow it consistently over hundreds of trades, that statistical edge can produce long-term profits. The challenge is that the human brain is not naturally wired to handle probabilistic outcomes well. We crave certainty, fear losses more than we enjoy gains, a concept known as loss aversion, and often make impulsive decisions based on short-term emotions rather than long-term logic. This emotional conflict becomes even more intense when real money is on the line. The fear of losing, the thrill of winning, the frustration of missing a move, all of these can cloud judgment and push traders away from rational decision-making. It's not uncommon for a trader to experience analysis paralysis, where they overthink every trade due to a recent loss, or revenge trading, where they try to win back a loss by entering impulsive trades without proper setups. These psychological traps are what destroy accounts, not the strategy itself. What separates the professional trader from the amateur is not that the professional has eliminated emotions, this is impossible, but that they have learned to recognize, manage, and work with their emotions rather than against them. They know how to step back, follow their plan, and trust the process even during drawdowns. They are patient when the market is slow and disciplined when it's volatile. They don't become overly euphoric after a big win or emotionally shattered after a loss. Instead, they maintain an even keel, understanding that trading is a long-term game, not a series of random events. Many professional traders also emphasize psychological conditioning over strategy development. They journal their emotions and decisions, meditate to stay focused, follow routines to reduce mental fatigue, and limit screen time to avoid burnout. These mental tools are just as critical as technical tools, if not more so. In fact, many hedge fund managers and institutional traders use surprisingly simple trading systems, but their edge comes from emotional consistency, risk control, and psychological endurance. In conclusion, while strategies are necessary, they are not sufficient. Without the ability to control your behavior in the face of uncertainty, a strategy is just a set of instructions easily ignored or distorted by emotion. Psychology is what bridges the gap between knowledge and action. It is what allows a trader to execute with confidence, manage risk responsibly, and remain committed through ups and downs. Until this mental foundation is built, no strategy, no matter how powerful, can deliver sustainable results. Part 2. The Mind of a Trader. Self-awareness, the first step to psychological mastery. Self-awareness is the foundation upon which all psychological mastery in trading is built. Without it, a trader cannot begin to identify the emotional and behavioral patterns that drive their decisions, both good and bad. In the heat of the market, traders are constantly influenced by subconscious impulses: fear of losing, desire for validation, impulse to chase, hesitation to pull the trigger. These reactions happen in real time, often without conscious thought. That's why the ability to observe yourself in action, to notice your own thought patterns, emotional triggers, and decision-making biases is critical to long-term trading success. Self-awareness in trading means being able to pause and recognize, for example, that you're entering a trade not because it meets your setup criteria, but because you're frustrated after a previous loss. It means catching yourself before revenge trading, or acknowledging when your confidence has turned into overconfidence after a string of wins. Most traders lack this internal mirror. They act and react but don't take the time to examine why they're doing what they're doing. As a result, they repeat the same mistakes, often blaming the market, the broker, or the news, instead of looking inward. Developing self-awareness requires conscious effort. One of the most powerful tools is journaling, not just trade outcomes, but emotions, thoughts, and behaviors around each decision. Over time, patterns emerge. You begin to notice that your worst trades happen late in the day when you're tired, or that you tend to take excessive risk after a winning streak. This kind of introspective data is more valuable than any technical indicator because it tells you exactly where your weaknesses lie and where you need to focus your psychological development. Another key to self-awareness is mindfulness, the practice of observing your thoughts and emotions in the present moment without judgment. Traders who cultivate mindfulness can more easily separate signal from noise, both in the market and within their own minds. Instead of being swept away by fear or excitement, they learn to observe those emotions, accept them, and respond with intention rather than instinct. This doesn't mean becoming emotionless, it means becoming emotionally intelligent, capable of feeling without reacting blindly. Self-aware traders also know their personality type and how it interacts with their trading style. Are you risk-averse or risk-seeking? Do you thrive in fast-paced markets or prefer a slower, more calculated approach? Are you prone to boredom, which leads to overtrading? By understanding these traits, you can choose or design strategies that align with your natural temperament, increasing both your consistency and your comfort with your process. Ultimately, self-awareness is about taking full responsibility for your actions. It means acknowledging that you are the variable in your trading results, not the market. The market is neutral, it doesn't care about your feelings, your needs, or your goals. Only by turning the lens inward, by examining your own thoughts, habits, and beliefs, can you gain control over the only thing you truly can control in trading, yourself. Part 3. The Mind of a Trader. Discipline and Consistency. In trading, discipline is the bridge between intention and results, and consistency is the reward for crossing it daily. These two traits are not just helpful, they are absolutely essential. Most traders come into the market with the ambition to make money, but very few come prepared to act with discipline. They have strategies, setups, and risk management rules, but when emotions take over, whether it's fear, greed, boredom, or overconfidence, discipline is often the first thing to go. And without discipline, no strategy will work in the long run. Forex trading is a game of probabilities, and the only way to realize the edge of a system is to execute it consistently over time. This is where most traders fail, not in strategy design, but in implementation. Discipline means doing what needs to be done even when you don't feel like doing it. It means sticking to your stop loss even when the market is close to reversing. It means not trading when your setup isn't there, no matter how tempting the price action looks. It means following your routine, journaling your trades, and managing your risk even on days when you're tired, frustrated, or distracted. It is the boring, repetitive commitment to process that ultimately produces consistent outcomes. Consistency comes as a byproduct of that discipline. It doesn't mean never making mistakes, it means maintaining a structured approach to trading that doesn't fluctuate wildly based on mood or recent performance. Consistent traders follow a plan. They use the same criteria for entering and exiting trades. They risk the same amount per trade. They review their performance regularly. Over time, this repetition builds muscle memory and confidence, which further reinforces the ability to stay disciplined under pressure. In contrast, inconsistent traders make emotional, reactive decisions that erode any potential edge they might have had. One of the hardest challenges in trading is that success often means doing the same thing day after day, without immediate gratification. The markets don't always reward good behavior in the short term. You can follow all your rules perfectly and still lose money on a trade. And sometimes you can break every rule and still come out with a profit. This randomness is what trips up undisciplined traders. They start equating outcome with correctness, and that leads to chasing wins and avoiding process. Disciplined traders, however, separate the quality of their decision-making from the short-term results. They understand that the outcome of one trade is irrelevant. It's the cumulative outcome of hundreds of trades, executed with consistency, that matters. It's also important to note that discipline isn't a trait you're born with. It's a skill you can develop. Just like physical training builds strength and stamina, mental training builds focus and control. Start small. Commit to one rule. Stick to your stop loss for the next 10 trades, no matter what. Build from there. Create rituals and routines around your trading day, like a pre-market checklist, scheduled review time, and periods of rest. Over time, these practices build internal discipline and external consistency, which together form the core of professional trading behavior. In the end, traders who succeed over the long term are not those who win every day or who find the perfect setup. They are the ones who show up, follow their process, and stay grounded trade after trade, month after month. Discipline and consistency are the quiet forces that turn trading from a gamble into a profession. Chapter 2. Emotions in the Market. Understanding Fear and Greed. In trading, few forces are more powerful or more dangerous than fear and greed. These two emotions don't just influence decisions, they can completely override logic, distort perception, and sabotage even the most well-thought-out strategies. Traders often underestimate their influence, but unless they are understood and managed, fear and greed will control the outcome far more than any technical indicator ever could. The psychology of fear in trading. Fear stems from a basic biological function, survival. In life-threatening situations, fear is vital. It keeps us from taking unnecessary risks. But in trading, where risk is calculated and expected, fear can be paralyzing. It causes traders to act irrationally, often in direct contradiction to their plans. The fear of losing money, for instance, might cause someone to close a position prematurely before it hits their target just to lock in a small gain. While it may feel safe, this behavior cuts into the strategy's profitability over time and signals a lack of trust in the system. Then there's the fear of being wrong, which is tied to ego and identity. For some traders, every trade becomes a statement of self-worth. Winning confirms competence, losing feels like failure. This leads to dangerous behaviors like refusing to close a losing trade, hoping the market will turn around and prove them right. But trading is not about being right, it's about being profitable over time, even if many individual trades are losses. Another fear is FOMO, the fear of missing out. It causes traders to jump into trades late, chase price after a breakout, or enter trades without a proper setup just because everyone else seems to be profiting. FOMO is driven by comparison, impatience, and the illusion that opportunity is scarce. But the truth is, the market is infinite in opportunity. The real scarcity is in patience and discipline. The psychology of greed in trading. Greed, on the surface, looks like ambition. It's the desire to make more, capitalize on moves, and grow quickly. But unchecked greed leads to overtrading, overleveraging, and abandoning risk management. After a string of wins, a trader might feel invincible and increase their position size far beyond their rules. Or they might hold onto a profitable trade far longer than planned, hoping for a bigger payday, only to watch it reverse and wipe out all gains. Greed often masquerades as optimism, but it's really a lack of discipline and an obsession with short-term gains. It convinces traders that rules are meant to be broken and that exceptional results justify exceptional risks. Over time, though, this behavior leads to large losses that can undo months of progress in a single trade. It's important to realize that greed isn't just about money. It can be about proving something to oneself, to others, or to the market. It can stem from insecurity, impatience, or even boredom. And like fear, it's subtle. It whispers just this once. Double the position. You've earned it. But those whispers are rarely harmless. Recognizing the signs. Traders who lack emotional awareness often don't realize they're being driven by fear or greed until after the damage is done. That's why self-observation is crucial. Here are some signs to watch for. You hesitate to enter valid setups because of a recent loss, fear. You close trades early out of anxiety only to see them hit your target, fear. You increase your position size after a win even though nothing has changed in your strategy, greed. You keep moving your stop-loss farther away to give it more room, fear of loss. You abandon your plan and enter impulsively after a market move, FOMO, greed. You feel euphoric after a win and impulsively look for another trade, greed. The more you can identify these emotional cues in real time, the more control you gain over your actions. Shifting your relationship with emotion. The goal is not to become emotionless. That's unrealistic and even unhealthy. The goal is to develop emotional intelligence, the ability to notice your emotional state without becoming enslaved by it. This requires reflection, journaling, mindfulness, and, above all, a mindset shift. You must stop seeing fear and greed as enemies to be suppressed and start seeing them as signals to be understood. When fear shows up, ask, is this a valid threat, or am I reacting to discomfort? When greed appears, ask, is this trade aligned with my plan, or am I chasing a feeling? Over time, this reflective practice builds a space between feeling and action, and in that space lies your power to choose. Professional versus emotional traders. Professional traders manage emotions like a pilot manages turbulence. Calmly, with systems and checklists, trusting the process. They have accepted that emotions will come, but they don't have to act on them. In contrast, emotional traders are like passengers. gripping the seat, reacting to every bump, and letting fear or greed dictate their every move. The journey to trading mastery is not just about learning to read the market. It's about learning to read yourself and respond with clarity, control, and commitment to your plan. Part 2. Emotions in the market. How emotions distort decision-making. When emotions take control in trading, they fundamentally alter the way the brain processes information and makes decisions, often leading to costly mistakes that undermine even the best trading strategies. This distortion begins at the neurological level. Strong emotions like fear and greed trigger the release of chemicals such as adrenaline and cortisol, which prime the brain for fight or flight responses rather than calm, analytical thinking. Under this chemical storm, traders become vulnerable to cognitive biases, mental shortcuts that simplify decision-making but skew perception and judgment. One of the most common biases is confirmation bias. When a trader feels emotionally invested in a trade idea, they unconsciously seek out information that confirms their beliefs while dismissing contradictory evidence. For example, if a trader believes a currency pair will rise, they might focus only on bullish news or technical signals, ignoring signs of weakness or reversal. This bias filtering reinforces the trader's commitment to the position, often leading to holding losing trades longer than they should or increasing risk unnecessarily. Closely related is loss aversion, a bias where the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Traders experiencing loss aversion tend to exit winning trades too early to lock in profits, but hold losing trades too long in the hope of breaking even. This behavior disrupts the optimal risk-reward balance critical to long-term profitability. For instance, a trader might close a profitable position after a small gain while stubbornly refusing to cut a losing trade, which can spiral into larger losses. Loss aversion amplifies emotional stress and leads to a cycle of poor decision-making where losses compound and gains are limited. Emotions also warp the perception of risk. When fear dominates, traders become overly cautious, setting extremely tight stop losses or avoiding trades entirely. This overreaction can cause missed opportunities and erode potential profits. On the flip side, greed or overconfidence creates the illusion that risk is low and reward is guaranteed. A trader flush with recent wins might increase position size dramatically or ignore stop-loss levels, believing they are on a roll. Such behavior exposes the trader to catastrophic losses when the market inevitably turns, eroding capital and confidence. Impulsivity is another distortion fueled by emotion. Instead of patiently waiting for setups that meet their criteria, emotional traders react to market noise and sudden price movements. This leads to overtrading, entering trades without sufficient analysis, or revenge trading, where a trader chases losses impulsively in an attempt to recover quickly. Both behaviors typically result in poor trade quality, increased transaction costs, and diminished psychological resilience. For example, after a losing day, a trader might impulsively enter a risky position outside their plan, driven by frustration or desperation rather than rational assessment. Time perception is also warped by emotions, contributing to biases like recency bias, where recent events disproportionately influence decision-making. After a series of wins, traders might become overconfident and loosen discipline, while a string of losses might provoke fear-driven avoidance or hesitation. This feedback loop between outcomes and emotions creates volatility in trading behavior, making it difficult to stick to a consistent plan. Emotional highs and lows distort the true probabilities and dynamics of the market, preventing objective analysis. Understanding these emotional distortions is vital because they explain why many traders fail to implement even profitable strategies consistently. The problem rarely lies with the strategy itself, but rather with the trader's inability to manage the internal psychological state. To counteract these distortions, traders must develop self-awareness and implement structures that reduce emotional influence. Keeping a detailed trading journal that records not only trade details but emotional states and thought processes can reveal recurring patterns. Mindfulness techniques help traders observe their emotional responses without immediate reaction, creating mental space to choose disciplined actions over impulsive ones. Predefining clear rules for trade entry, exit, and risk management is another crucial tool. By committing to these rules in advance, traders reduce the cognitive load during high-pressure moments, minimizing the impact of emotional bias. Some traders also use automated tools like alerts or even algorithmic execution to enforce discipline and remove emotion from the decision loop. In essence, emotions in trading act like a fog that clouds judgment and obscures the logical pathways to success. While emotions cannot be eliminated, they are an inherent part of the human experience that can be managed through awareness, structure, and practice. Successful traders learn to recognize when emotions are distorting their view, pause to reassess with clear criteria, and make decisions based on strategy rather than impulse. This emotional mastery is what separates consistent winners from those who cycle through frustration and losses. Part 3: Emotions in the Market. Managing Emotional Reactions. Mastering the art of managing emotional reactions is arguably the single most important skill a Forex trader can develop. Trading is an emotional roller coaster, marked by rapid price movements, uncertainty, and constant risk. Without effective emotional management, even the most robust trading plans can collapse under pressure. But emotional management is not about eliminating feelings, that would be unrealistic and unhealthy, but about cultivating the ability to acknowledge, understand, and regulate emotions so they serve your trading goals instead of sabotaging them. The foundation of managing emotions is self-awareness. This means becoming intimately familiar with your own emotional triggers and bodily reactions during trading. For example, you might notice your heart racing or your hands trembling when a trade moves against you, or feel a surge of excitement when you spot what looks like a perfect setup. These physical sensations are clues that your emotional system is activated. Developing the habit of pausing and checking in with yourself at these moments creates crucial space between emotion and action. This pause allows you to avoid impulsive decisions driven by fear, greed, or frustration and instead choose a thoughtful, plan-based response. Techniques drawn from mindfulness practices are highly effective here. Simple exercises like deep breathing, focusing on the present moment, or brief meditation can calm the nervous system and improve emotional regulation. Traders who regularly practice mindfulness report better concentration, less impulsivity, and greater resilience to market stress. Even a few minutes of mindfulness before and during trading sessions can set a tone of calm awareness that buffers against emotional hijacking. Creating and adhering to clear rules and routines is another pillar of emotional control. Emotions thrive in ambiguity. When decision criteria are vague or inconsistent, fear and greed rush in to fill the gap. When you have a written, well-tested trading plan with specific rules for entries, exits, stop-loss placement, and risk sizing, you reduce the opportunity for emotional interference. These rules act like guardrails, keeping you on course when the market gets volatile. Routines such as performing a daily checklist, reviewing your journal, and analyzing your trades at set times build discipline and reinforce the mental habits that sustain emotional control. Acceptance and mindset also play a crucial role in emotional management. Many traders struggle emotionally because they equate losses with personal failure or their self-worth with their win rate. This mindset creates unnecessary pressure and emotional volatility. Cultivating a mindset of acceptance means recognizing that losses are an inevitable part of trading and that no trader wins 100% of the time. By reframing losses as learning opportunities rather than personal defeats, you reduce the emotional charge around them. This mental shift supports resilience, enabling you to bounce back quickly and maintain consistent execution. Understanding your personal emotional triggers is equally important. Different traders react differently to various stressors. Some may become overly cautious after a losing streak. Others may become reckless after a few wins. Identifying these patterns requires honest self-reflection and sometimes feedback from mentors or trading peers. Once identified, you can develop tailored coping strategies, such as taking a break after consecutive losses, reducing position size during emotional highs, or using affirmations to maintain confidence. Physical health should not be overlooked in managing emotions. Trading is mentally demanding, and the brain functions best when the body is well cared for. Lack of sleep, poor nutrition, and physical inactivity all contribute to heightened stress sensitivity and impaired decision-making. Prioritizing good sleep hygiene, balanced meals, and regular exercise builds the physical resilience that supports mental clarity and emotional stability during trading. Additionally, cognitive tools such as reframing, which involves consciously changing negative or unhelpful thoughts into more balanced perspectives, can be powerful. For example, instead of thinking, "I'm terrible because I lost that trade," you might reframe it as losing trades are part of the game and this is an opportunity to learn and improve. Another helpful technique is visualization, where you mentally rehearse executing trades calmly and according to plan, building confidence and reducing anxiety. Finally, seeking support through communities, mentors, or coaching can provide external accountability and emotional support. Trading can be isolating, and having a network to discuss emotions and experiences helps normalize challenges and provides practical strategies for coping. In conclusion, managing emotional reactions is a lifelong practice that integrates self-awareness, structured routines, mindset shifts, physical care, cognitive strategies, and social support. Traders who invest in developing this skill create the mental environment necessary to execute strategies consistently, adapt to market changes with equanimity, and build lasting success in Forex trading. Chapter 3. Discipline and its impact. The role of self-discipline in Forex trading. Self-discipline is arguably the most vital quality a Forex trader can cultivate, acting as the backbone that supports all other skills and strategies. In an environment as volatile and psychologically demanding as the Forex market, knowledge and analysis alone are not enough. Without self-discipline, traders often fall prey to impulsive behaviors, emotional decision-making, and inconsistent execution, which inevitably erode profits and confidence. Discipline is the bridge between having a well-crafted trading plan and successfully implementing it under real market conditions. At its essence, self-discipline is the ability to maintain strict adherence to your trading plan, no matter the circumstances. This includes following precise rules for trade entry and exit, setting and respecting stop-loss and take-profit levels, and managing position sizes appropriately. It means resisting the urge to deviate from your strategy because of emotional impulses, whether driven by fear, greed, impatience, or frustration. For example, a disciplined trader won't chase the market after a missed opportunity or double down recklessly after a winning streak. Instead, they will patiently wait for their setup to materialize according to the rules they have tested and trusted. This steadfastness requires a high level of mental fortitude. The Forex market can be unpredictable and sometimes harsh. Losses are inevitable and winning streaks often punctuated by losing trades. Traders without discipline might abandon their plan after a few losses, either by taking excessive risks in an attempt to win it back, or by stepping out of the market altogether in fear. Conversely, disciplined traders understand that losses are part of the journey and accept them as the cost of doing business. They trust their methodology, knowing that consistent application over time will yield positive results. This mindset prevents emotional reactions from overriding logical decision-making. Patience is a key aspect of discipline in Forex trading. Markets don't always present perfect opportunities, and some days may go by with very few or no trades meeting your criteria. A disciplined trader recognizes that forcing trades when conditions are not favorable is a fast track to poor results. Instead, they conserve their capital and wait for setups that align with their tested strategies. This contrasts sharply with impulsive traders who often overtrade, entering many suboptimal trades driven by boredom, anxiety, or the need for immediate gratification. Overtrading not only increases transaction costs but also amplifies emotional stress and reduces overall effectiveness. Discipline also encompasses risk management, arguably the most critical element of trading longevity. A disciplined trader rigorously applies risk controls, never risking more than a predetermined percentage of their capital on a single trade, always using stop losses and sizing positions based on volatility and account size. This prudence prevents large drawdowns that can emotionally destabilize traders and derail their progress. It's often said that protecting your capital is more important than making profits, and disciplined risk management is the practical expression of that philosophy. Building self-discipline is not an overnight process. It requires deliberate practice and often a series of small, consistent actions that reinforce good habits. Keeping a trading journal to document not just trades but also adherence to rules and emotional states can help identify moments where discipline falters. Reflecting on these experiences enables traders to recognize patterns such as entering trades out of impatience or failing to exit losing positions and develop corrective strategies. Successful traders often use routines and rituals to anchor discipline. This might include pre-market preparation, setting alerts, reviewing trade setups carefully before execution, and post-market journaling. These structured habits reduce the cognitive load during stressful moments, making it easier to stick to the plan. Some even use automation or algorithmic tools to enforce discipline by removing human emotion from trade execution. In summary, self-discipline in Forex trading is much more than simply doing what you're supposed to do. It is a multifaceted skill that involves controlling impulses, maintaining patience, rigorously managing risk, and developing mental resilience. It transforms trading from a gamble into a professional endeavor governed by consistent, repeatable actions. Those who master discipline position themselves to survive the inevitable challenges of the market and capitalize on opportunities with confidence and clarity, making it the true foundation of long-term trading success. Part 2. Discipline and its impact. Building consistency through routine and habit. Consistency is often touted as the secret to success in Forex trading, and for good reason. The financial markets are dynamic, volatile, and influenced by countless unpredictable factors. This environment can overwhelm even experienced traders, leading to erratic decisions and emotional responses. Building a solid foundation of routines and habits is the antidote to this chaos. By embedding disciplined behaviors into your daily trading life, you create a reliable framework that enables you to operate systematically and confidently regardless of external market conditions. The cornerstone of consistency lies in developing structured daily routines. This typically begins with thorough preparation before the trading day officially starts. Successful traders allocate dedicated time to review economic calendars, news events, geopolitical developments, and overnight price action. This pre-market analysis allows them to identify potential opportunities, assess risks, and develop a clear game plan for the day. Instead of reacting to the market's noise as it unfolds, they enter the trading session with a focused mindset and well-defined objectives. This practice also reduces surprises and emotional stress during trading hours. Creating a checklist of these preparatory steps can significantly enhance consistency. Checklists help ensure nothing important is overlooked, such as verifying technical setups, confirming risk limits, or checking for key market open times, and help foster a habit of thoroughness. Over time, these checklists and routines become second nature, acting as an anchor amid the fast pace of Forex markets. Execution routines are equally critical. One of the most common pitfalls for traders is impulsive decision-making, where emotions drive premature or ill-considered trades. By developing a habitual process of carefully verifying entry criteria and adhering to stop-loss and take-profit rules, traders instill discipline into each trade. This habit prevents the temptation to deviate from tested strategies in the heat of the moment. For example, a trader might habitually set stop-loss orders immediately upon entering a trade, rather than postponing this critical risk control step and exposing themselves to unnecessary losses. Another key element is the habit of consistent trade journaling and review. Successful traders make it routine to record not only the technical details of each trade, such as entry and exit points, position size, and outcome, but also their emotional state and thought process at the time. This habit of detailed reflection builds valuable self-awareness, helping traders identify recurring emotional triggers or deviations from their plan. Over weeks and months, journaling creates a rich database of lessons that inform better decision-making and strategy refinement. Without this habit, traders risk repeating the same mistakes and falling into destructive emotional cycles. Forming these routines requires deliberate commitment and often involves overcoming initial discomfort. Humans are naturally resistant to change, and breaking impulsive, emotionally driven behaviors takes effort. Traders may face moments of frustration when they feel constrained by their routines or tempted to skip steps in the interest of speed or perceived opportunity. However, it is precisely during these moments that the strength of habit proves its value. Routines serve as mental guardrails, steering behavior back toward consistency and rationality. To build and maintain strong routines, many traders incorporate lifestyle habits that support their trading mindset. This includes prioritizing regular sleep patterns, maintaining physical fitness, managing stress through mindfulness or exercise, and minimizing distractions during trading hours. A healthy body and mind create the optimal environment for discipline and focus, allowing traders to execute routines reliably day after day. Moreover, some traders employ automation tools to reinforce routines and reduce emotional interference. For instance, setting automated alerts for key price levels or using trading platforms that enforce stop-loss placement can help embed risk management habits. Algorithmic trading systems or semi-automated strategies also help remove the emotional element from trade execution, fostering greater consistency. The long-term benefits of routine and habit formation extend beyond immediate trading outcomes. They build confidence and psychological resilience, reducing anxiety and helping traders maintain a steady mindset through the inevitable ups and downs of the market. This consistency feeds a virtuous cycle. Consistent behavior produces more predictable results, which in turn boosts confidence and further strengthens disciplined habits. In essence, routine and habit are the scaffolding that supports disciplined trading. They transform what might otherwise be a stressful and erratic endeavor into a systematic, professional process. Traders who invest time and effort into cultivating strong routines position themselves to navigate the complexities of the Forex market with clarity, confidence, and control, laying the groundwork for sustained success. Part 3. Discipline and its impact. Overcoming common challenges to discipline. Maintaining discipline in Forex trading is often easier said than done. Even traders with the best intentions and thorough plans encounter significant hurdles that test their resolve. These challenges arise from psychological pressures, market unpredictability, and personal life factors that can undermine focus and consistency. Understanding these common challenges deeply and equipping yourself with practical strategies to navigate them is crucial to building lasting discipline and sustained trading success. One of the most insidious threats to discipline is emotional fatigue or burnout. Trading requires intense concentration, rapid decision-making, and continual emotional regulation, which can exhaust even the most experienced traders' mental resources. Over long sessions or during periods of high market volatility, the brain's capacity to manage stress diminishes. This depletion manifests in lapses of judgment such as neglecting to set stop losses, deviating from your trading rules, or taking impulsive trades out of boredom or frustration. To counteract fatigue, it's essential to build balance into your routine. This includes scheduling regular breaks during trading hours, limiting total trading time, ensuring consistent quality sleep, and engaging in activities outside trading that rejuvenate your mind, whether that's exercise, hobbies, or social time. Mindfulness and meditation practices are also proven methods to restore mental energy and enhance emotional resilience. Overconfidence is another common obstacle, particularly dangerous because it often follows periods of success. When traders hit a winning streak, they may begin to believe their skill or luck is infallible. This mindset can lead to reckless behaviors like increasing trade sizes beyond their normal risk parameters, skipping stop-loss orders just this once, or ignoring the trading plan altogether. Such overconfidence inflates risk exposure and often results in large, unexpected losses. The antidote to overconfidence is humility grounded in objective self-assessment. Keeping a detailed trading journal with performance metrics helps maintain perspective by highlighting both successes and failures over time. Regularly reviewing this data fosters awareness that no trader is immune to losses, and consistent adherence to strategy is what sustains profitability. Seeking feedback from mentors or trading communities can also provide reality checks that curb overconfidence. Fear and anxiety can equally disrupt discipline. In volatile markets or unfamiliar situations, fear may freeze a trader into inaction or provoke premature exits from trades, missing out on potential profits. Anxiety, on the other hand, can cause frantic, irrational decisions, closing positions too early, abandoning strategies mid-trade, or overreacting to minor market moves. Managing these emotions requires building emotional resilience through preparation and mental training. Gradual exposure to different market scenarios combined with simulated or small-size trading helps desensitize the nervous system to market stress. Breathing exercises, mindfulness meditation, and visualization techniques can calm the mind during live trading. Developing a strong belief in your trading plan and risk management rules also reduces fear by creating a safety net. Discipline is also frequently compromised by external distractions and lifestyle factors. Trading in noisy, chaotic environments, multitasking during market hours, or trading while physically or mentally tired reduces concentration and increases errors. Personal stressors such as financial pressure, relationship conflicts, or health issues often seep into trading psychology, undermining emotional stability and focus. To mitigate these effects, traders should create a dedicated, quiet trading space free of distractions and establish a consistent trading schedule aligned with their peak alertness times. Practicing good time management and stress reduction techniques in daily life also supports trading discipline. One of the most destructive challenges is the urge to chase losses, known as revenge trading. After a loss, the emotional response often drives a trader to take impulsive, high-risk trades to quickly make back money. This reaction is usually fueled by frustration, impatience, and emotional reactivity rather than sound analysis. Revenge trading frequently leads to a downward spiral of increasing losses and emotional turmoil. Recognizing this pattern early is vital. Disciplined traders learn to step away from the screen after a losing trade, take time to cool down, and reassess their strategy calmly before re-engaging. Setting rules such as no new trades after a losing trade or limiting the number of trades per day can also curb revenge impulses. Lastly, a lack of clear, realistic goals undermines discipline by creating uncertainty and eroding motivation. Without specific objectives tied to process, e.g., maintain a risk-reward ratio of at least 1 to 2, or never risk more than 2% of capital per trade, traders may drift from their plans or lose interest during difficult stretches. Effective goal setting provides structure, focus, and a sense of progress. Breaking large goals into smaller, measurable milestones increases motivation and accountability. Regularly reviewing and adjusting goals based on experience helps maintain relevance and drive. Overcoming these challenges is a continuous journey that demands patience, self-compassion, and commitment. Discipline is not about being perfect but about cultivating awareness and developing strategies to manage setbacks. Traders who anticipate these obstacles and proactively address them build mental toughness and create an environment conducive to consistent, rational trading. In doing so, they set themselves apart from those who succumb to emotional chaos and inconsistent behaviors, paving the way for long-term success in the Forex market. Chapter 4. Mastering Emotional Control. Understanding emotional triggers in Forex trading. Emotions play a profound role in Forex trading, often influencing decisions in ways traders may not consciously realize. The Forex market is a fast-paced, high-stakes environment where rapid price fluctuations and unpredictable news events continuously test a trader's psychological resilience. Emotional triggers are the specific stimuli, both internal and external, that provoke strong emotional reactions. These can be market-related events like sudden price spikes or sharp declines, consecutive winning or losing trades, unexpected economic announcements, or even personal states such as fatigue, hunger, or stress. Recognizing and understanding these triggers is critical for maintaining emotional control and making disciplined, rational decisions. The first step toward mastering emotional triggers is developing self-awareness through introspection and systematic observation. Traders can begin by keeping a detailed journal not only of their trades but also of their emotional states before, during, and after each trade. For instance, a trader might notice a recurring pattern where a small loss sparks anxiety, leading to impulsive attempts to win it back with risky trades. Or they might observe that after a period of sustained profits, feelings of overconfidence arise, prompting larger-than-usual position sizes or relaxed risk management. These emotional patterns reveal how specific triggers influence behavior and highlight areas that require conscious intervention. Emotional triggers are often tied to basic psychological needs and fears, such as the fear of loss, the need for approval, or the desire for quick success. For example, the fear of losing money can cause hesitation or panic selling, even when the trading plan suggests holding a position. Similarly, the thrill of winning can stimulate greed, pushing traders to overtrade or take unnecessary risks. By delving deeper into these underlying emotions, traders can understand why certain triggers provoke strong reactions, moving beyond surface behaviors to address root causes. Techniques such as journaling, cognitive behavioral strategies, or even professional counseling can assist traders in this emotional exploration. Once identified, managing emotional triggers involves developing coping mechanisms that interrupt automatic, impulsive responses. One effective method is to create mental pause buttons during trading, simple practices that force a moment of reflection before action. This might involve taking deep breaths, stepping away from the screen for a few minutes, or reviewing one's trading plan and risk limits before executing a trade. These small actions help reduce the intensity of emotional responses and promote a more considered approach. Another powerful strategy is to establish predefined rules and routines that guide behavior irrespective of emotional states. For example, traders might set strict criteria for trade entries and exits that cannot be overridden by feelings of fear or greed. By automating parts of the trading process, such as placing stop-loss orders immediately upon entry or using algorithmic alerts, traders reduce the room for emotional interference. These structures act as guardrails, maintaining discipline when emotional triggers strike. Mindfulness and meditation practices have gained traction as effective tools for enhancing emotional regulation in traders. Mindfulness encourages present-moment awareness and non-judgmental observation of thoughts and feelings, enabling traders to recognize emotional triggers without being overwhelmed by them. Regular mindfulness practice builds mental resilience, allowing traders to respond to triggers calmly rather than reactively. It is also essential to acknowledge that emotional triggers can be exacerbated by external factors like fatigue, poor diet, or personal stress. Ensuring physical well-being through adequate sleep, nutrition, exercise, and stress management creates a stronger foundation for emotional control. When the body and mind are healthy, traders are better equipped to handle the psychological demands of the Forex market. In conclusion, understanding emotional triggers is the gateway to mastering emotional control in Forex trading. By developing self-awareness, exploring the root causes of emotional reactions, and implementing practical coping strategies, traders can reduce the negative impact of emotions on their decisions. This emotional mastery supports disciplined trading, reduces impulsive mistakes, and ultimately enhances consistency and profitability in the Forex market. Emotional control is not about suppressing feelings but managing them skillfully, transforming potential vulnerabilities into sources of strength and clarity. Part 2. Mastering Emotional Control. Techniques for managing stress and anxiety in Forex trading. Stress and anxiety are natural reactions to the pressures and uncertainties inherent in Forex trading. The constant need to make quick decisions, manage risk, and absorb unpredictable market news creates a high-stakes environment that can overwhelm even seasoned traders. When stress and anxiety go unmanaged, they cloud judgment, fuel emotional reactions, and often lead to poor trading decisions such as impulsive entries, premature exits, or abandonment of risk controls. Learning to manage these emotions effectively is therefore essential for maintaining clarity, discipline, and consistency in trading. One of the simplest yet most effective techniques for stress reduction is controlled breathing. Stress activates the sympathetic nervous system, commonly known as the fight or flight response, which increases heart rate, tightens muscles, and heightens alertness. Deep, slow breathing counteracts this by stimulating the parasympathetic nervous system, which promotes relaxation and calm. For example, practicing the 4-7-8 breathing technique. Breathing in slowly for 4 seconds, holding the breath for 7 seconds, and exhaling gently for 8 seconds. Can be done anywhere, anytime, even mid-trade, to instantly lower anxiety and regain composure. Over time, integrating such breathing exercises into daily routines helps traders maintain a calmer baseline emotional state. Mindfulness meditation builds on this by training the mind to observe thoughts and emotions without judgment or reaction. Instead of trying to suppress anxiety or stress, mindfulness encourages traders to acknowledge these feelings as passing mental events. This creates a mental pause between feeling stressed and reacting impulsively, allowing more thoughtful decision-making. Research shows that regular mindfulness practice enhances emotional regulation, focus, and resilience, skills critical for traders facing volatile markets. Beginners might start with short guided meditations of 5 to 10 minutes, gradually increasing duration as comfort grows. Apps like Headspace or Calm can provide helpful structure and reminders. Physical activity is another powerful tool for managing stress and anxiety. Engaging in regular exercise releases endorphins, natural mood enhancers, that improve overall well-being and reduce tension. Aerobic activities such as jogging, swimming, or cycling not only promote cardiovascular health but also sharpen cognitive function and reduce mental fatigue. For traders, even brief bouts of exercise like a 10-minute walk or stretching session during breaks can improve mood and refresh focus. Incorporating exercise into daily routines fosters a healthy mind-body connection that supports better emotional control under pressure. Setting realistic expectations is also vital for reducing anxiety. Many traders suffer from performance pressure, worrying about profits, fearing losses, or feeling the need to prove themselves. This pressure amplifies stress and can lead to rash decisions. By shifting focus from outcomes to process, such as executing trades according to a plan, maintaining risk discipline, and logging trades for review, traders build confidence and reduce emotional volatility. Accepting that losses are inevitable and learning from them transforms anxiety into a manageable, even motivating force. Creating a supportive trading environment further mitigates stress. This includes minimizing distractions such as turning off unnecessary notifications or working in a quiet, comfortable space and structuring trading hours to avoid fatigue and burnout. Additionally, having a community or mentor network offers emotional support, perspective, and encouragement, reducing feelings of isolation and overwhelm. Sharing experiences and strategies within these networks helps normalize challenges and reinforces disciplined habits. In moments of acute stress, having a toolkit of immediate coping strategies is invaluable. Stepping away from the trading desk for a few minutes to clear your head, listening to calming music, practicing progressive muscle relaxation, tensing and relaxing muscles sequentially, or even brief visualization of successful trades can help restore calm and focus. Developing personalized rituals such as a quick walk or a cup of tea creates mental cues that signal a transition from stress to calm. Managing stress and anxiety is a continuous, proactive process, not a one-time fix. It requires commitment to self-care, emotional awareness, and practical habits that strengthen resilience. Traders who prioritize these techniques find themselves better equipped to navigate the emotional roller coaster of Forex trading with poise and clarity. Over time, managing stress becomes second nature, supporting disciplined decision-making and consistent performance in even the most volatile market conditions. Part 3. Mastering emotional control. Developing a trading routine to enhance emotional stability. In the fast-moving and often unpredictable world of Forex trading, the emotional landscape can be just as volatile as the market itself. For many traders, emotional instability leads to impulsive decisions, inconsistent results, and ultimately burnout. Developing a disciplined trading routine is not merely about systematizing technical steps but about creating a comprehensive mental and physical framework that supports emotional stability and resilience over the long haul. A routine provides structure in an environment defined by uncertainty, offering traders a reliable, safe harbor that fosters calmness, focus, and confidence. Preparation is the cornerstone of any effective trading routine. A well-prepared trader reduces the chances of being caught off guard by market events, which often trigger stress and anxiety. This preparation phase should ideally begin before the trading session starts and include a review of key economic indicators, upcoming news releases, and overnight market developments. For example, a trader might check the economic calendar each morning to identify high-impact events like central bank announcements or employment reports, which could cause volatility. By mapping out potential market-moving events and aligning these with their trading strategy, the trader feels more in control and less prone to panic when unexpected price swings occur. During preparation, setting clear, realistic trading goals is equally vital. Goals should focus not just on profit targets but on executing specific actions aligned with the trader's plan, such as sticking to risk management rules or limiting the number of trades per day. For example, a goal might be only take trades that meet the established criteria and risk no more than 1% of capital per trade. This focus on process over outcome reduces emotional pressure and reinforces discipline, helping the trader maintain a steady mindset regardless of profits or losses. Moving into the trading session, rituals that promote mental and physical centering can dramatically improve emotional regulation. Many traders find value in simple mindfulness or breathing exercises before logging into their trading platforms. Such rituals act like mental reset buttons, helping to calm nerves and sharpen attention. Even taking a few moments to stretch or do a quick body scan, mentally noting any areas of tension and consciously relaxing them, can reduce physical stress that might otherwise translate into emotional volatility. These rituals establish a psychological cue that signals it's time to focus, enhancing the trader's readiness to engage with the market thoughtfully rather than reactively. Throughout the trading session, maintaining emotional equilibrium requires deliberate pacing and breaks. Trading Forex is mentally demanding. It requires constant vigilance and rapid decision-making. This can quickly lead to cognitive fatigue, which makes emotional control more difficult. Incorporating regular breaks, stepping away from the screen every hour or so to hydrate, stretch, or practice brief relaxation techniques refreshes the mind and body. For example, a trader might set a timer reminding them to pause for 5 minutes every 60 minutes, ensuring sustained alertness without burnout. These breaks help prevent emotional exhaustion and impulsive decisions that often arise when the mind is fatigued. A crucial yet sometimes overlooked part of the trading routine is the post-trade review process. Emotionally, the period after a trading session can be highly sensitive, especially if the day included losses or unexpected market moves. Taking time to systematically review each trade, focusing not only on technical execution but also on emotional responses, builds self-awareness and supports continuous improvement. A trader might record details such as the reasons for entering and exiting trades, the outcome, and feelings experienced before, during, and after the trade. For instance, noting a tendency to feel anxious during volatile markets can highlight emotional triggers that require attention. Over time, this reflective practice helps traders identify and adjust unproductive emotional patterns, transforming setbacks into valuable learning experiences rather than sources of stress. Beyond the immediate trading context, the development of a consistent routine must encompass holistic lifestyle habits. Physical health profoundly affects emotional stability. Sleep deprivation, poor nutrition, and lack of exercise can amplify stress, impair concentration, and weaken emotional resilience. For example, a trader who starts the day with a nutritious breakfast, engages in regular physical activity, and prioritizes 7 to 8 hours of sleep each night will have a more robust capacity to manage the emotional ups and downs of trading. Integrating practices such as yoga, journaling, or hobbies outside of trading also helps reduce overall stress levels, ensuring the trader approaches the market with a fresh and balanced mindset. Finally, the power of routine lies in its ability to create predictability and control in an inherently uncertain environment. Market conditions fluctuate wildly, news breaks unexpectedly, and prices often move irrationally. Having a structured routine allows traders to anchor themselves amidst this chaos. It acts as a behavioral compass, guiding actions regardless of external turbulence. Over time, these routines become deeply ingrained habits, shaping not only trading behavior but also emotional responses. Rather than succumbing to fear, greed, or frustration, traders who commit to their routines develop a mindset characterized by calmness, discipline, and confidence, essential ingredients for long-term success. In conclusion, developing a comprehensive and consistent trading routine is one of the most effective strategies for enhancing emotional stability in Forex trading. By investing time in preparation, centering rituals, paced trading sessions, reflective reviews, and healthy lifestyle choices, traders build a psychological and physical framework that supports rational decision-making and resilience. This routine-driven approach transforms trading from an emotional roller coaster into a mindful, disciplined practice, enabling traders to navigate the dynamic Forex markets with steadiness, clarity, and sustained profitability. Part 4. Mastering Emotional Control. Overcoming Fear and Greed in Forex Trading. Fear and greed are two of the most fundamental and powerful emotions influencing human behavior, and nowhere is their impact more profound than in Forex trading. These emotions can hijack even the most carefully planned strategies, leading to impulsive, irrational decisions that undermine profitability and consistency. Understanding, managing, and ultimately overcoming fear and greed is essential for any trader aiming to maintain emotional equilibrium and achieve long-term success. Fear in trading often arises from the prospect of loss or uncertainty. It can manifest in several detrimental ways, including hesitation to enter trades, exiting positions too early out of panic, or avoiding trading altogether after experiencing losses. For example, a trader might hesitate to place a trade even when their analysis shows a high probability setup because the fear of losing capital feels overwhelming. This hesitation can cause missed opportunities and erode confidence over time. Alternatively, fear might lead a trader to prematurely close a winning trade too soon, sacrificing potential gains for a sense of safety. The root of fear is usually an emotional response to risk, uncertainty, and past negative experiences that trigger a fight-or-flight reaction. Greed, on the other hand, arises from the desire for excessive gains or the fear of missing out on profit opportunities. It can drive traders to overtrade, take on larger-than-planned positions, or hold losing trades in hope of a reversal. For example, a trader riding a winning streak might increase position sizes impulsively, disregarding risk limits, hoping to maximize profits. Similarly, greed can cause a trader to chase the market by entering trades late, driven by the urge to capture quick profits, often at a much higher risk. This excessive risk-taking often leads to severe losses that can wipe out previous gains. Greed clouds judgment by amplifying optimism and downplaying risk, leading to reckless behavior. The first crucial step in overcoming fear and greed is developing heightened self-awareness. Traders must learn to identify when these emotions arise, how they feel physically and mentally, and how they influence decisions. Physical signs of fear include rapid heartbeat, sweaty palms, muscle tension, or a feeling of tightness in the chest. Greed may be accompanied by restlessness, impatience, or an overexcited mental state. Keeping a detailed trading journal that records not just the technical details but also emotional states and thought patterns helps traders spot recurring emotional triggers. For example, noting that fear spikes before major news events or greed intensifies after consecutive wins can provide valuable insight for managing these feelings proactively. To manage fear and greed, traders should implement robust risk management rules that act as guardrails. This includes setting fixed stop-loss orders, defining position sizes as a small percentage of the trading account, often 1 to 2%, and adhering to a maximum daily loss limit. These rules help traders accept that losses are a normal part of trading and reduce the fear of catastrophic loss. They also prevent the temptation to over-leverage driven by greed. For instance, knowing that a maximum of 1% of capital is at risk per trade allows a trader to execute setups confidently without the paralyzing fear of ruin. Shifting focus from outcomes to process-oriented goals further helps in curbing fear and greed. Instead of obsessing over profits or losses, traders should value consistent execution of their trading plan, adherence to risk parameters, and disciplined analysis. For example, a goal like follow my entry and exit rules exactly is more constructive than make $500 today. This mindset reduces emotional reactivity because the trader judges success based on controllable behaviors rather than unpredictable results. Over time, achieving process goals builds confidence and emotional resilience, creating a positive feedback loop. Mental rehearsal and visualization are powerful psychological tools to prepare for emotionally charged scenarios. Traders can practice imagining themselves reacting calmly and rationally to losing trades, drawdowns, or unexpected market volatility. This mental training conditions the brain to respond with composure rather than panic or impulsivity when real situations arise. Regular mindfulness meditation complements this by training traders to observe their thoughts and emotions non-judgmentally, reducing the grip of fear and greed. Finally, engaging with a support network, whether through trading communities, mentors, or coaches, provides external perspective and accountability. Sharing experiences normalizes the emotional challenges, reducing isolation and shame often associated with fear or greed-driven mistakes. A mentor can help reinforce disciplined behavior and offer practical advice during emotional turbulence. Peer groups encourage honest reflection and provide encouragement, helping traders stay grounded. In summary, fear and greed are powerful forces that can either destroy or define a trader's success. By cultivating self-awareness, enforcing strict risk management, focusing on process goals, practicing mental rehearsal, and seeking support, traders can overcome these emotional obstacles. Mastering fear and greed enables traders to act with discipline, patience, and clarity, paving the way for sustainable profitability and emotional well-being in the demanding world of Forex trading. Chapter 5. Building Mental Strength. The Role of Confidence in Forex Trading. Confidence is the cornerstone of successful Forex trading. It acts as the mental fuel that propels traders from analysis to action. In a market environment defined by uncertainty, rapid changes, and constant risk, confidence enables traders to navigate complexity with composure and conviction. Yet, confidence is not a static trait that traders either have or lack. It is a dynamic quality that can be consciously developed, tested, and refined over time. At the heart of confidence lies self-efficacy, a psychological concept referring to an individual's belief in their capacity to execute tasks and reach goals. In trading, self-efficacy influences how traders approach challenges, interpret failures, and persevere through difficulties. Traders with high self-efficacy believe in their ability to stick to their strategy, manage losses, and learn from mistakes. This belief fosters a proactive attitude, where challenges are viewed as opportunities to grow rather than threats to avoid. Conversely, low self-efficacy breeds doubt and hesitation, often leading to missed opportunities or premature exit from trades. Developing this belief begins with competence, building a strong foundation of knowledge and skill. Competence grows through education, practice, and real-world experience. Traders who invest time in learning about market mechanics, technical and fundamental analysis, and risk management develop a clearer understanding of what to expect and how to respond to various market conditions. This deep knowledge reduces anxiety by transforming the unknown into something familiar and manageable. For example, a trader well-versed in candlestick patterns and economic indicators will feel more assured interpreting market movements than someone relying solely on gut feelings. However, competence alone is not enough. Reflective experience. The ability to critically evaluate one's trades and decisions is essential for converting experience into confidence. Keeping a detailed trading journal allows traders to identify recurring patterns in their behavior, emotional responses, and strategy performance. This ongoing self-assessment helps traders distinguish between luck and skill, recognize biases, and refine their approach. For instance, if a trader notices a pattern of exiting trades too early due to fear, they can consciously work on this tendency, gradually building trust in their strategy's longer-term signals. Emotional regulation is another critical component linked to confidence. Forex trading inherently triggers strong emotions like fear, greed, excitement, and frustration. Confident traders manage these emotions by maintaining a balanced mindset. They neither become paralyzed by fear nor reckless from greed. This emotional equilibrium is achieved through disciplined routines, mindfulness practices, and adherence to risk management rules. For example, by consistently risking only a small percentage of their capital per trade, confident traders minimize the emotional impact of any single loss, enabling clearer thinking and sustained focus. While confidence empowers traders, it must be tempered by humility to avoid the dangers of overconfidence, a frequent cause of large losses. Overconfident traders tend to underestimate risks, ignore stop-loss rules, and overtrade, often after a string of wins. Maintaining humility means recognizing the market's inherent unpredictability and accepting that losses are inevitable. This mindset keeps traders grounded, encouraging continuous learning and adaptability. Accepting uncertainty and failure is fundamental to developing resilient confidence. The Forex market offers no guarantees. Even the best strategies encounter losing streaks. Traders who accept this reality maintain confidence by focusing on executing their plan well and controlling what they can, the process, not on uncontrollable outcomes. This process-oriented mindset builds resilience, allowing traders to bounce back quickly from setbacks with renewed focus. A well-structured risk management framework supports confidence by creating boundaries that safeguard capital and reduce fear. Knowing that every trade is carefully sized and protected by stop-loss orders gives traders peace of mind to execute trades decisively. For example, limiting risk to 1 to 2% of the account per trade means that even a series of losses won't be catastrophic, reinforcing the trader's trust in their system. Confidence also combats analysis paralysis, a common problem where excessive deliberation and doubt prevent timely action. The Forex market moves quickly, and hesitation often results in missed entry points or suboptimal exits. Confident traders act decisively, trusting their preparation and accepting that no decision is risk-free. This decisiveness often translates into better trade execution and results. Practically, traders can cultivate confidence through deliberate habits. Consistent practice on demo and live accounts helps internalize strategies and build comfort. Continual education keeps skills sharp and knowledge up to date, reducing uncertainty. Trading journals promote reflection, learning, and emotional awareness. Visualization and mental rehearsal prepare the mind to handle stressful trading scenarios with calmness. Mindfulness and meditation enhance emotional regulation and present moment focus. Seeking mentorship or peer support provides feedback, encouragement, and perspective. Ultimately, confidence fuels the mental strength that allows traders to operate effectively in the face of the Forex market's challenges. When rooted in competence, reflective practice, and emotional control and balanced with humility, it becomes a sustainable, empowering force. This mental edge is often what separates consistent winners from those who struggle to maintain discipline and focus amid the market's volatility. Part 2. Building mental strength. The impact of self-doubt and how to combat it. Self-doubt is a formidable adversary in the psychological landscape of Forex trading. While it may seem like a mere feeling or fleeting thought, self-doubt deeply influences a trader's behavior, mindset, and ultimately, their performance. Unlike the more obvious emotions of fear or greed, self-doubt is often a subtle, pervasive internal voice that questions the trader's competence and decision-making. This internal questioning, am I prepared enough? Did I miss something important? What if I'm wrong? Can escalate into a crippling cycle of hesitation, second-guessing, and emotional distress. At its core, self-doubt is linked to cognitive distortions such as catastrophizing, expecting the worst possible outcome. All-or-nothing thinking, believing a mistake means total failure, and confirmation bias, focusing on evidence that confirms inadequacy while ignoring successes. These mental patterns distort reality and amplify uncertainty, creating a fog that clouds judgment and fuels anxiety. For instance, after a single losing trade, a trader plagued by self-doubt might irrationally believe their entire strategy is flawed, disregarding previous successes and the inherent randomness of market movements. Psychologically, self-doubt can be exacerbated by the human brain's natural aversion to uncertainty and loss, rooted in evolutionary survival mechanisms. The amygdala, the brain's fear center, can trigger heightened emotional responses to perceived threats like losing money or making a bad trade, causing the trader to become hypervigilant and overly cautious. This heightened state can lead to overthinking and paralysis, where the fear of making a mistake outweighs the potential reward of acting. Over time, such avoidance behaviors degrade skill development and erode confidence, perpetuating the self-doubt cycle. In practical terms, self-doubt often manifests as analysis paralysis, the inability to make timely decisions due to excessive scrutiny and fear of error. Traders might endlessly scan charts, read multiple conflicting analyses, or delay execution waiting for a perfect signal that never comes. This hesitation not only causes missed opportunities but can also provoke impulsive revenge trading later as frustration builds. Additionally, self-doubt may lead to frequent rule-breaking, such as moving stop losses, overtrading, or abandoning strategies mid-cycle, all of which harm consistency and increase losses. To combat self-doubt, traders must first cultivate self-awareness, the conscious recognition of their thoughts, emotions, and physical sensations as they arise. Practices like journaling emotions alongside trade data reveal patterns and triggers of doubt, empowering traders to intervene early. For example, recognizing that doubt spikes after losing streaks allows a trader to adopt coping strategies proactively, rather than reacting in the moment. Establishing a robust, rules-based trading system is a critical anchor against self-doubt. When a trader trusts a system grounded in tested logic and sound risk management, the mental burden shifts from, "What should I do?" to, "Am I following my plan?" This shift reduces emotional reactivity and provides clear criteria for action, enabling decisive trading even amid market chaos. A detailed trading plan acts like a GPS, guiding the trader and minimizing the mental noise that feeds doubt. Gradual exposure to the markets, starting with small trade sizes, serves as behavioral therapy for self-doubt. Small stakes mean smaller emotional risks, allowing the trader to build confidence incrementally through experiential learning. This process mirrors how athletes train, starting with controlled, low-risk drills before performing in high-pressure competitions. Over time, as competence and resilience grow, the trader can scale up exposure without overwhelming anxiety. Mental conditioning techniques further enhance resilience. Cognitive restructuring, actively challenging and reframing negative beliefs, helps replace unhelpful thoughts, "I'm going to fail," with balanced, constructive ones, "I'm prepared and will learn regardless of outcome." Visualization exercises simulate trading scenarios mentally, training the brain to respond calmly to both winning and losing trades. Mindfulness meditation develops metacognitive awareness, enabling traders to observe doubts as transient mental events rather than truths, which reduces emotional reactivity. Moreover, building a support network mitigates the isolating effects of self-doubt. Trading communities, mentors, or coaches provide objective feedback and emotional encouragement, normalizing the experience of doubt and reinforcing perseverance. Hearing others' stories of overcoming doubt and setbacks reduces shame and instills hope. Mentors, in particular, can identify blind spots and cognitive distortions, helping traders stay on track with their plans and mental conditioning. Incorporating feedback loops through journaling and performance review completes the self-doubt management cycle. By objectively assessing trades and separating outcome from process, traders learn to view losses as data points rather than personal failures. This mindset shift from outcome fixation to process orientation is vital for maintaining confidence and motivation over the long term. In conclusion, self-doubt is a natural, though potentially debilitating, part of the Forex trading journey. It arises from deep-seated cognitive biases, emotional responses to uncertainty, and the high-stakes nature of financial markets. However, it can be overcome through deliberate self-awareness, disciplined systems, gradual exposure, mental training, and social support. By transforming self-doubt from a paralyzing fear into a manageable challenge, traders develop the mental strength needed to persist, learn, and ultimately succeed in the demanding world of Forex trading. Part 3. Building mental strength. The importance of emotional regulation in Forex trading. Forex trading is an arena that demands not only technical skill but exceptional emotional mastery. The stakes are high, the market moves fast, and the consequences of each decision, whether profit or loss, are immediately tangible. This environment naturally triggers intense emotional responses such as anxiety, excitement, frustration, greed, and fear. Emotional regulation. The ability to recognize, understand, and manage these feelings is what distinguishes consistently successful traders from those who struggle. Without it, traders risk allowing transient emotions to cloud judgment, leading to impulsive trades, deviation from strategy, and ultimately financial loss. The foundation of emotional regulation lies in the brain's complex interplay between the emotional centers and the rational control areas. The amygdala, which processes emotions like fear and anxiety, can hijack decision-making during stressful moments, particularly in volatile markets or when a trader experiences a loss. When this emotional hijacking occurs, the brain's prefrontal cortex, responsible for reasoning and impulse control, can be temporarily overridden, resulting in knee-jerk reactions rather than measured choices. This neurological reality explains why even experienced traders can find themselves making uncharacteristic mistakes when under pressure. One common emotional pitfall is the fight or flight response, where a trader either freezes, avoids making decisions, or impulsively exits trades to avoid further perceived loss. Another is the chase behavior driven by greed or desperation, causing traders to double down on losing positions in the hope of recovery, which often leads to larger losses. Both patterns illustrate a failure of emotional regulation and highlight why controlling emotional responses is paramount. Developing emotional regulation begins with cultivating emotional intelligence, the capacity to identify, understand, and manage one's own emotions as well as empathize with others. Traders with high emotional intelligence are better equipped to notice early signs of stress, anxiety, or overconfidence. They recognize how these emotions influence their thinking and behavior, enabling proactive adjustments. This might mean pausing before entering a trade, revisiting the trading plan, or even stepping away from the screen to regain composure. Self-awareness techniques such as journaling emotional states alongside trading activity are invaluable. By tracking moments when emotions spike, perhaps after unexpected market moves or during consecutive losses, traders gain insights into their personal triggers. This awareness empowers them to develop personalized coping strategies, turning emotional red flags into manageable cues rather than overwhelming forces. In practice, several techniques help traders modulate their emotions effectively. Mindfulness meditation has gained prominence in recent years for its role in improving emotional regulation. Mindfulness teaches traders to observe their thoughts and feelings without judgment, creating psychological distance that reduces impulsive reactions. By focusing on the present moment, traders prevent their minds from spiraling into worry about past mistakes or future uncertainties, which often fuel anxiety and fear. Breathing exercises, such as slow, deep diaphragmatic breaths, activate the parasympathetic nervous system, the body's rest and digest mode, which counteracts stress responses. Integrating brief breathing sessions before and during trading can help maintain a calm, focused mindset even amid market turbulence. Another vital component of emotional regulation is preparation and structure. A comprehensive trading plan that includes clear entry and exit rules, risk management parameters, and contingency protocols reduces ambiguity, the primary source of emotional stress. When a trader has a roadmap, decisions become rule-based rather than emotion-driven. For example, a trader who knows they risk only 1 to 2% of their capital per trade and uses stop-loss orders can tolerate losses without panic, knowing their overall portfolio remains protected. Routine also plays a crucial role. Having consistent pre-trading and post-trading rituals like reviewing news, checking technical setups, journaling, or doing relaxation exercises helps stabilize emotions and creates mental readiness. Routines serve as psychological anchors, signaling the brain to enter a focused, professional mindset, which can dampen emotional volatility. Building emotional resilience is equally important. Resilience involves the capacity to bounce back from losses or setbacks without losing confidence or becoming emotionally unbalanced. It's fostered by adopting a growth mindset, viewing trading challenges as opportunities for learning rather than personal failures. This perspective shifts the focus from outcome obsession to process mastery, which protects traders from the emotional roller coaster of wins and losses. Social support systems such as trading groups, mentors, coaches, or even friends and family offer emotional validation and perspective. Trading can be isolating, and emotional struggles often intensify in solitude. Engaging with others provides a space to share experiences, receive constructive feedback, and reduce the shame or frustration that self-doubt and losses may bring. Mentors, in particular, can model emotional regulation and help traders develop strategies for managing stress and maintaining discipline. Finally, regular performance analysis and journaling serve as emotional regulation tools by promoting objectivity. Reviewing trades dispassionately, separating feelings from facts, enables traders to recognize that losses are part of the game and not reflections of personal inadequacy. This objective mindset reduces emotional reactivity, helping traders maintain consistency and stay aligned with their long-term goals. In summary, emotional regulation is not an optional skill but an essential pillar of Forex trading success. It enables traders to navigate the intense psychological demands of the market with clarity, patience, and discipline. Mastering emotional regulation transforms fleeting, potentially destructive emotions into valuable information and strategic insight. It empowers traders to stick to their plans, learn from experience, and maintain the mental stamina required for sustained profitability. Cultivating this skill is a lifelong journey but one that pays profound dividends in trading and in life. Part 4. Building mental strength. Developing patience and long-term thinking in Forex trading. In a trading world that rewards speed, instant access, and quick results, patience and long-term thinking can feel counterintuitive. Yet they are absolutely essential for sustained success in Forex. Many traders enter the market with unrealistic expectations of overnight riches fueled by social media success stories or marketing hype. This mindset often leads to impulsive behavior, overtrading, and emotional burnout. The reality is that Forex trading, like any professional endeavor, requires time, discipline, and a strategic mindset that values growth over gratification. Developing patience and cultivating a long-term perspective enables traders to avoid emotional traps and remain focused on what truly drives profitability, consistency, discipline, and a solid edge. Patience in trading means waiting for high-probability setups and avoiding the temptation to enter trades out of boredom, fear of missing out, FOMO, or the need to make something happen. This can be incredibly challenging, especially in the 24-hour Forex market where opportunities seem endless. Yet, successful traders know that selectivity is strength. They recognize that quality trades aligned with their strategy are worth waiting for, while random, emotionally driven trades often result in unnecessary losses. Patience helps traders stay aligned with their edge rather than chasing short-term excitement or trying to force trades that aren't there. Long-term thinking, on the other hand, shifts the trader's focus from individual trade outcomes to overall system performance over time. Instead of obsessing over whether the next trade will win or lose, long-term-minded traders evaluate whether they are consistently executing their plan and following their rules. They understand that even the most effective trading systems have losing streaks and drawdowns, but that the law of large numbers will ultimately reflect their edge if they remain consistent. This mental shift reduces the emotional pressure of each trade and creates a more stable and objective trading mindset. Patience also plays a critical role in letting trades develop once entered. Impatient traders frequently close trades too early out of fear of losing unrealized profits or anxiety from watching price fluctuations. This behavior, known as cutting winners short, limits reward potential and disrupts the balance of risk-to-reward ratios necessary for long-term success. Patient traders, on the other hand, trust their plan and allow trades to unfold according to their strategy, even when it means sitting through temporary drawdowns or pullbacks. Cultivating patience and long-term thinking requires mental training and structured practices. One approach is using a trade checklist before each trade to reinforce discipline and ensure the setup meets all criteria. This reduces impulsive decisions. Journaling not only trades but also thoughts and emotions can help traders spot impatience in action, such as entering too early, chasing the market, or exiting without cause. By identifying these habits, traders can replace them with deliberate, rule-based actions. Goal setting also reinforces long-term thinking. Traders should set process-oriented goals like follow my plan for 20 consecutive trades or review my trading journal weekly rather than purely outcome-based ones like make $1,000 this week. This encourages focus on consistency, which is within the trader's control, rather than short-term results, which are often influenced by market noise. Celebrating the discipline of sticking to a plan rather than the profitability of individual trades builds the patience and psychological endurance needed for long-term performance. Additionally, backtesting and forward testing strategies help traders build confidence in their system. When traders see data that validates their edge over hundreds of trades, it becomes easier to resist emotional urges and wait for proper setups. This statistical confidence reinforces patience by showing that success comes from long-term execution, not short-term emotion. Finally, patience requires acceptance of uncertainty. Forex markets are inherently unpredictable, and not every trade will work out even if executed perfectly. Traders must embrace this uncertainty without trying to control or eliminate it. Patience is the mindset that allows them to operate within that uncertainty with calm and discipline, trusting the process and focusing on the broader horizon. In conclusion, developing patience and long-term thinking in Forex trading is not just a helpful trait, it's a strategic necessity. These qualities anchor traders during periods of volatility, reduce impulsivity, and strengthen the consistency needed to realize the full potential of a well-crafted trading plan. By resisting the lure of instant gratification and embracing a mindset of strategic endurance, traders build the psychological resilience required to succeed in the Forex markets over the long haul. Part 5. Building Mental Strength. Turning Losses into Learning Opportunities expanded. For many traders, the pain of a losing trade is more than just financial, it's deeply psychological. Losses can evoke shame, frustration, fear, self-doubt, and even anger. They challenge a trader's confidence and often trigger destructive behaviors such as revenge trading, abandoning proven strategies, or retreating completely from the market. However, losses are not inherently negative. In fact, they are among the most valuable experiences a trader can have if approached with the right mindset. Learning to transform losses into stepping stones rather than stumbling blocks is one of the most profound psychological shifts a trader can make. The first step in this transformation is reframing the meaning of a loss. Most people are conditioned from a young age to view losing as failure, something to be avoided, punished, or hidden. In Forex trading, this mentality is not only unhelpful but dangerous. Since losses are inevitable even with the most sophisticated strategies and flawless execution, traders who equate losing with failure set themselves up for disappointment and emotional volatility. The mentally strong trader, however, understands that a loss is neutral. It is feedback, not failure. It is information, not an indictment. And like all data, it holds clues about the market, the trader's system, and the trader's mindset. This reframing process requires emotional maturity. It involves learning to separate identity from outcome, in other words, understanding that I had a losing trade is not the same as I am a loser. This subtle shift reduces shame and guilt, allowing traders to approach losses with curiosity rather than defensiveness. Asking the question, what is this loss trying to teach me, instead of why am I so bad at this, opens the door to insight and improvement. One of the most powerful tools for turning losses into learning is the trading journal. However, many traders use journals superficially, recording entries, exits, and P&L without examining the deeper layers of each trade. A psychologically aware trader uses the journal to explore. What was I feeling before I entered this trade? Did I follow my trading plan precisely? If not, why not? Was this loss part of expected strategy performance, or was it avoidable? Was I trading emotionally or from a place of calm logic? These reflections help uncover behavioral patterns that lead to poor trades, such as overtrading during stress, breaking rules after a big win, or hesitating to exit a losing position. Over time, a trader can compile a personal map of psychological tendencies, making it easier to anticipate and neutralize self-sabotaging habits. It's also important to analyze the type of loss. All losses fall into categories. 1. Execution losses, when a mistake was made, e.g., wrong entry, late exit, position sizing error. 2. Discipline losses, when the trade was outside the strategy, often emotionally driven. 3. Strategy losses, when the trade was executed perfectly but simply didn't work out due to market conditions. This classification is crucial. Execution and discipline losses require behavioral changes, strategy losses require patience and perspective. Failing to distinguish between them can lead traders to overhaul perfectly good strategies just because of short-term noise, or worse, to ignore self-destructive habits. To make the most of a loss, traders should create a feedback loop, not just identifying what went wrong, but making a specific change or commitment moving forward. For example, If a trader realizes they rush entries after a win, they may commit to a 5-minute pause between trades. If they notice emotional overreaction to losses, they might implement a cool-down rule, such as taking a walk before placing the next order. If they discover their strategy performs poorly in ranging markets, they might filter out trades during low volatility hours. Each of these changes turns the pain of a loss into a tangible improvement in performance. Another layer to consider is how losses affect confidence. Many traders unconsciously build their confidence on win streaks and crumble when they face setbacks. True trading confidence, however, must be rooted in process, not outcome. If a trader has done their analysis, followed their plan, managed their risk, and still lost money, that's not a failure. That's a professional execution. Confidence built on that kind of integrity is far more stable and resilient than confidence built on P&L. Traders must also accept that losses can teach them things that wins cannot. Wins often reinforce habits, whether good or bad, because the positive outcome can mask poor decisions. A trader might break their rules and still profit, which can send the wrong psychological message. Losses, however, force introspection. They demand honesty. They break ego. And this discomfort, while painful, is the crucible where mental strength is forged. Lastly, viewing losses as learning opportunities fosters a growth mindset, the belief that skills can be developed through effort, feedback, and resilience. Traders with a growth mindset embrace the long game. They understand that short-term pain is the price of long-term skill. They don't run from hard lessons, they run toward them. In conclusion, turning losses into learning opportunities is not just a skill, it's a philosophy. It is the foundation of psychological evolution in trading. Every loss contains a seed of insight. The traders who cultivate those seeds rather than discarding them become not only better at trading, but stronger, wiser, and more emotionally fortified. This mindset doesn't just change your trading, it changes how you respond to adversity in every part of life. Chapter 6. Greed and the Illusion of Quick Wealth. How greed sabotages consistent performance. Greed is one of the most deceptive and destructive psychological forces in Forex trading. While the desire to make money is natural and necessary for participation in the markets, unchecked greed often transforms that healthy motivation into compulsive behavior that sabotages long-term success. The illusion of quick wealth fuels impulsive decision-making, tempts traders to abandon their rules, and blinds them to risk. When a trader becomes focused solely on how much they could make, they begin to prioritize short-term gains over strategic execution, which inevitably leads to inconsistency and losses. Greed distorts a trader's perception of risk and reward. It pushes them to take larger positions than their account can reasonably handle, to enter trades based on hope rather than logic, and to stay in losing positions too long while chasing an unrealistic profit target. It whispers that one big trade could change everything, that doubling the account quickly is better than growing it methodically. This mindset directly conflicts with what actually produces success in Forex: discipline, risk control, and patience. Greed replaces those traits with urgency, overconfidence, and the constant need to hit it big, which destroys consistency. Consistent performance in trading is the result of repeated, process-driven actions, sticking to your edge, respecting your risk parameters, and avoiding emotional swings. Greed, on the other hand, creates volatility in the trader's behavior. One day they're cautious, the next they're risking half their account on a single setup. This inconsistency damages not only their equity curve but also their psychological resilience. Over time, the trader begins to feel out of control, not because the market is wild, but because their own internal state is unstable. Greed is the fuel behind that instability. What makes greed especially dangerous is that it often masquerades as ambition or confidence. A trader may justify oversized trades as aggressive risk-reward plays or convince themselves that they're seizing a rare opportunity. But underneath that rationalization is often a fear of missing out, impatience, or the need to prove something. True confidence comes from following a proven process, not from taking reckless risks. Greed hijacks that sense of control, pushing traders into trades that don't align with their strategy, timeframes, or emotional state. To maintain consistency, traders must learn to recognize the emotional signals of greed, the racing heartbeat before clicking buy, the desire to skip a trading journal after a big win, or the sudden urge to double down after a profitable trade. These are not signs of strength, they are warnings that discipline is slipping. The most successful traders are those who can feel the pull of greed, acknowledge it, and still stick to their process. They know that consistency comes not from chasing profits, but from managing risk and making high-quality decisions over time. Ultimately, greed sabotages consistent performance by shifting the trader's focus from process to profit. It replaces calm objectivity with emotional urgency. And once a trader starts making decisions driven by the need to get rich quickly, they become vulnerable to the very behaviors overtrading, overleveraging, revenge trading that destroy trading accounts. The antidote to greed is not the absence of ambition but the presence of discipline. True wealth in trading is built not on one big win, but on thousands of small, smart decisions executed with patience and clarity. Part 2. Greed and the Illusion of Quick Wealth. Avoiding revenge trading and overleveraging. Revenge trading and overleveraging are two of the most insidious traps a trader can fall into, both rooted deeply in emotional responses triggered by loss and greed. These behaviors often arise from a natural but dangerous impulse, the desire to quickly recover losses and regain control. However, the very act of attempting to get back at the market or amplify potential profits through excessive leverage usually results in magnified risks and severe drawdowns. The challenge lies in recognizing these impulses early and responding with discipline rather than reaction. Revenge trading begins as a response to frustration and disappointment. After a losing trade, emotions run high. Anger, self-doubt, and desperation mix together, creating a volatile mental state. In this heightened emotional zone, the trader is no longer operating from a clear, objective mindset but from one clouded by the urge to prove they can win back what was lost. This leads to rash decisions. Entering trades without proper setups, abandoning stop-loss discipline, or increasing trade sizes impulsively. Instead of stepping back and analyzing what went wrong, the trader dives in deeper, hoping to erase losses quickly. This emotional cycle becomes self-reinforcing, where each loss intensifies the urge to revenge trade, creating a downward spiral that can decimate both the trader's capital and confidence. Compounding this danger is the frequent use of overleveraging, the practice of controlling larger positions than the account balance prudently allows. Leverage magnifies both gains and losses, so when combined with revenge trading, it can quickly turn a manageable loss into a catastrophic blow. Traders driven by greed or emotional turbulence might convince themselves that taking on bigger positions is justified because the next trade will fix everything. This illusion is extremely risky. It assumes perfect market timing and ignores the reality of volatility and unpredictability inherent in Forex markets. Overleveraging puts immense pressure on the trader's psyche, increasing anxiety and impairing decision-making, which often leads to premature exits or holding onto losing trades in the hope of a turnaround. Avoiding these pitfalls requires more than just knowledge. It demands emotional mastery and structural safeguards. One essential practice is having a well-defined trading plan that includes strict risk management rules. Position sizes should be calculated based on a fixed percentage of the total account, often 1 to 2%, to prevent any single loss from threatening the account's integrity. By committing to these boundaries before entering the market, traders reduce the temptation to overleverage during emotionally charged moments. Equally important is cultivating emotional awareness. Successful traders learn to recognize the warning signs of revenge trading, such as a racing heart, impulsive urges, or a persistent preoccupation with recouping losses, and consciously choose to pause, reflect, and reset. This may involve taking a break from the screens, reviewing the trading journal, or engaging in calming activities like deep breathing or meditation. These moments of deliberate pause help break the cycle of reactive behavior and reinforce a mindset focused on process rather than outcome. In addition, maintaining a trading journal that logs emotional states alongside trades can provide invaluable insights. Over time, patterns emerge that reveal when revenge trading or overleveraging tendencies arise, allowing the trader to develop personalized strategies for intervention. This reflective practice builds resilience and encourages accountability. Finally, embracing the long-term nature of trading is a powerful antidote. Accepting that losses are inevitable and that consistent profitability comes from many small, well-managed trades rather than chasing big wins can alleviate the pressure that drives revenge trading and reckless leverage. Patience and discipline become allies in this journey, reminding traders that slow and steady growth, protected by prudent risk management, is the true path to sustainable success. In summary, avoiding revenge trading and over-leveraging is about controlling emotional impulses and implementing firm, process-driven safeguards. It requires acknowledging the emotional dynamics of trading, respecting risk boundaries, and fostering a mindset that prioritizes consistency over quick gains. Those who master this balance protect their capital and mental well-being, positioning themselves for long-term growth rather than short-term chaos. Part 3. Greed and the Illusion of Quick Wealth. Embracing slow, steady growth. In the fast-paced world of Forex trading, it's easy to get caught up in the allure of quick profits. The idea of making a large sum of money in a short period of time is seductive, and it's precisely this temptation that often drives traders toward risky behaviors like over-leveraging, revenge trading, or chasing the next big breakout. Yet, the most successful traders know that true wealth is built gradually through consistent and methodical decision-making rather than through the volatility of massive, high-risk trades. Embracing slow, steady growth is a cornerstone of trading psychology because it reinforces a focus on process, not results, and teaches traders to view trading as a marathon, not a sprint. The principle of slow, steady growth is rooted in the concept of compounding returns. Just as the value of an investment grows exponentially over time through reinvested dividends or profits, the same concept applies in trading. When traders focus on achieving consistent, incremental profits, whether it's 1%, 2%, or 5% per month, the cumulative effect over time can be staggering. For example, a trader who earns 2% per month year after year will experience significant growth in their capital. Conversely, a trader who tries to hit 20% or 30% returns in a short time through high-risk strategies may see their account skyrocket briefly, only to come crashing down when the inevitable drawdown occurs. The process of compounding requires patience, but its rewards are far more predictable and sustainable in the long run. Risk management is at the heart of slow, steady growth. Traders who prioritize long-term growth protect their capital by adhering to strict risk management rules, such as risking only a small percentage of their account balance on each trade. By keeping risk low and ensuring that no single loss can devastate their account, traders are able to withstand inevitable drawdowns without emotionally reacting or abandoning their strategy. This approach requires self-control and an understanding that no matter how good a trader's system or edge may be, losses are inevitable. What matters is the trader's ability to weather these losses and continue executing their plan without being derailed by the need to make up for those losses. Discipline is another key trait of traders who embrace steady growth. The consistent, methodical approach to trading means that successful traders don't let short-term setbacks or market noise influence their decisions. They follow a predefined strategy, whether it's based on technical analysis, fundamental analysis, or a combination of both, and they stick to it even when the market doesn't behave as expected. Emotional swings, such as fear after a loss or excitement after a win, are minimized through a disciplined approach to trading. When a trader acts out of emotion, they are more likely to make impulsive decisions, deviating from their plan and taking on risks that are disproportionate to the rewards. On the other hand, when they focus on consistency and gradual growth, each trade becomes a small, calculated step in the direction of long-term financial health. Patience is the other vital ingredient in embracing slow, steady growth. Many traders, especially beginners, fall into the trap of feeling like they need to be constantly active in the market. This impatience can lead to overtrading, where the trader enters positions that are not aligned with their strategy, simply to do something or to make up for a prior loss. However, profitable trading isn't about action for the sake of action. It's about making the right decisions at the right time. Traders who embrace slow, steady growth recognize that sometimes the best move is to wait for high-probability setups rather than rushing into the market at every opportunity. They understand that being patient with their strategy, taking time to evaluate the market, and waiting for optimal conditions is far more productive than forcing trades for the sake of feeling busy. Moreover, avoiding the temptation of high-risk, high-reward trades plays a key role in building a strategy that favors steady growth. High-risk trades might bring huge profits in the short run, but they also come with the potential for massive losses. These trades often lure traders in with the promise of huge returns, but the reality is that they are more akin to gambling than professional trading. In contrast, traders who embrace slow, steady growth focus on low-risk, high-probability trades that align with their edge and strategy. While these trades may not produce enormous profits in a short time, they are far more likely to yield consistent results over the long term. By avoiding the allure of chasing big wins, traders reduce the likelihood of catastrophic losses, and over time, they build a portfolio that appreciates steadily and reliably. Building psychological resilience is another component of slow, steady growth. The journey of Forex trading is not without its emotional challenges. Losses are inevitable and markets can be unpredictable. However, traders who focus on slow, steady growth develop the emotional fortitude to handle these challenges. They understand that no single trade defines their success. Instead, it's the consistent application of their strategy over many trades that leads to positive results. This resilience is built through repeated practice, self-reflection, and a commitment to learning from each trade, regardless of the outcome. It's the traders who can stay calm in the face of adversity and stay true to their process that find success in the long run. Finally, embracing slow, steady growth is about creating a trading lifestyle that aligns with long-term goals rather than short-term desires. Traders who seek immediate gratification often burn out or experience significant emotional stress as they chase the market. By shifting focus to sustainable growth, traders find a sense of balance. They approach trading as a profession rather than a get-rich-quick scheme, which allows them to manage expectations, set realistic goals, and track their progress over time. The pursuit of steady growth also means developing habits that support overall well-being, such as taking regular breaks, managing stress, and maintaining a healthy work-life balance, so that traders can continue trading for the long haul without falling victim to burnout. In summary, embracing slow, steady growth is the mindset shift that separates successful traders from those who fall prey to the illusion of quick wealth. It requires patience, discipline, risk management, and the willingness to accept that sustainable wealth is the result of incremental, consistent profits, not sudden, explosive gains. By focusing on preserving capital, adhering to a well-defined strategy, and viewing trading as a long-term endeavor, traders can avoid the emotional pitfalls of greed, revenge trading, and overleveraging. Slow, steady growth is not just a strategy, it's a mindset that enables traders to navigate the markets with clarity and purpose, ultimately building real wealth over time. Chapter 7. Overtrading and Impulse Control. The Dangers of Hyperactivity in the Markets. Overtrading is one of the most common psychological traps that traders fall into, especially when they're driven by emotions such as fear, greed, or the desire to make up for previous losses. Hyperactivity in the markets refers to the constant buying and selling of currency pairs, often driven by the urge to act rather than to wait for the right opportunities. While Forex markets can sometimes create a sense of urgency due to their fast-paced nature, excessive activity can quickly turn from strategic trading into impulsive, reactive decision-making. This behavior leads to numerous problems, from excessive transaction costs to emotional burnout and significant account drawdowns. Hyperactivity often stems from the desire to be constantly in the action, a common trait among traders who confuse activity with productivity. They may feel compelled to trade simply because the market is open or because they believe they should be doing something all the time to make money. However, real trading success comes from making thoughtful, well-reasoned decisions, not from being constantly in the market. Traders who engage in hyperactivity may not fully assess the market conditions or may enter trades on whims, leading to poor risk management and a string of losing trades that could have been avoided with more patience. One of the dangers of hyperactivity in trading is the emotional roller coaster it creates. The quick in-and-out nature of impulsive trades, especially when driven by excitement, frustration, or the hope of chasing profits can result in a highly volatile emotional state. A trader who overtrades may find themselves experiencing sharp highs and lows as they react to wins and losses in rapid succession. This can make it difficult for a trader to maintain a balanced, focused mindset, ultimately impairing their judgment and leading to further impulsive actions. This emotional instability not only hurts a trader's performance in the short term but can also contribute to long-term psychological burnout. When a trader is constantly reacting to market fluctuations, they might lose sight of the bigger picture, failing to adhere to their trading plan or strategy. Overtrading can also lead to excessive transaction costs. In Forex trading, every trade has a cost, whether it's through the bid-ask spread, commission fees, or slippage. Hyperactive traders may overlook these costs, thinking that frequent trading will lead to more opportunities for profit. However, these small, seemingly insignificant fees can accumulate quickly and eat into profits. In addition, overtrading can lead to a reduction in overall win rate due to the emotional and cognitive fatigue that comes from being constantly engaged in the market. The more trades a trader makes without a clear strategy or reasoning, the greater the likelihood that many of these trades will be unprofitable. Another danger is that overtrading can lead to poor risk management. When a trader is overly active, they may lose track of their risk per trade and end up over-leveraging their positions. This impulsive trading can result in taking larger than usual risks or increasing position sizes in an effort to make up for previous losses. This reactive approach to trading significantly increases the likelihood of large drawdowns, ultimately threatening the trader's capital and putting their entire account at risk. When a trader becomes consumed by hyperactivity, they are often making decisions based on emotional impulses rather than sound analysis, which undermines their ability to manage risk effectively. Another key issue with hyperactivity is that it can cause loss of focus. In Forex trading, the ability to stay disciplined and focused on a set of rules is crucial for long-term success. Constantly jumping from one trade to another can cause a trader to lose sight of their original plan, or worse, ignore their stop losses and profit targets. Overtrading creates distractions that prevent a trader from objectively evaluating the market or sticking to their strategy. Traders who are hyperactive may chase after trades that don't meet their usual criteria or jump into markets they haven't fully analyzed, leading to decisions that are disconnected from their overall strategy. The road to recovery. Recognizing hyperactivity is the first step toward overcoming it. Traders must learn to differentiate between productive engagement with the market, which involves patiently waiting for high-probability setups based on their strategy, and mindless trading, which is driven by emotion and the urge to do something simply because they feel they should. Understanding that the market doesn't require constant action is vital. Successful traders learn to embrace periods of inactivity when the market isn't presenting favorable setups, knowing that patience is a critical component of long-term success. A key strategy for avoiding hyperactivity is setting strict trading rules. This might include defining clear criteria for entering and exiting trades, as well as having a plan in place for how much time and energy you'll devote to trading each day. This ensures that trades are taken based on solid analysis and are not driven by the impulse to act. Additionally, setting trade limits, such as a maximum number of trades per day, can help to combat the urge to overtrade. When traders set strict limits and stick to them, they are less likely to make impulsive decisions or fall victim to emotional trading. In conclusion, hyperactivity in the markets is dangerous because it leads to impulsive, emotion-driven decisions that undermine profitability. Overtrading distorts a trader's perception of what is important, creates emotional instability, increases transaction costs, and puts the trader at risk of significant losses. By recognizing this behavior and implementing strategies like setting strict rules, reducing exposure to the market, and focusing on quality over quantity, traders can learn to avoid the trap of hyperactivity and engage in more thoughtful, disciplined trading. Part 2. Overtrading and impulse control. Spotting compulsive trading behavior. Compulsive trading is one of the most dangerous psychological pitfalls in Forex trading, and it can often go unnoticed until it has caused significant damage to a trader's capital and emotional well-being. Compulsive trading is characterized by excessive and often irrational trading decisions that are driven by emotions, urges, or external stressors rather than clear, objective analysis. Traders with compulsive behaviors often ignore their trading plans, risk management strategies, and the essential discipline required for long-term success. The key to breaking free from compulsive trading is recognizing it early and understanding its underlying causes so that you can take proactive steps to regain control of your trading psychology. Signs of compulsive trading behavior. 1. Trading out of boredom or frustration. One of the most common signs of compulsive trading is the urge to trade when there's no clear reason to do so. Many traders feel the need to be constantly active in the market even when conditions don't warrant it. Trading out of boredom, frustration, or the need to fill time can lead to reckless decisions. These trades often don't follow any logical analysis, and the trader is simply looking to do something to alleviate the emotional discomfort of inactivity or past losses. For example, a trader might jump into a market just because they feel the need to be busy or to make up for a previous loss. This kind of behavior is often subconscious, and the trader may not even realize they are doing it until it has led to significant losses. 2. Chasing losses, revenge trading. Another hallmark of compulsive trading is revenge trading, which occurs when a trader seeks to recover from a loss by taking excessive risks. This behavior is often triggered after a losing trade, where the trader becomes fixated on recovering the lost capital as quickly as possible. Revenge trading is typically emotional and impulsive as the trader disregards their trading plan and risks more than they normally would. This cycle of chasing losses often leads to larger losses, and the trader becomes caught in a destructive loop of overtrading and emotional decision-making. The desire to make it back becomes so overpowering that it clouds judgment and exacerbates the situation. 3. Overleveraging positions. Overleveraging is another key symptom of compulsive trading. Traders with compulsive behaviors may begin to take on excessive risk in an attempt to recover losses or increase profits in a short time. They might use high leverage to magnify potential gains, believing that they need to make large profits to make up for past mistakes. However, this approach dramatically increases the risk of a massive drawdown or account blowout. The trader becomes fixated on the idea of quickly making large profits, neglecting proper risk management. Overleveraging often stems from an emotional need for quick success or a desperation to avoid losses. 4. Frequent and small trades, no clear strategy. Traders who engage in compulsive trading often trade frequently and in small amounts, but without a clear strategy or purpose behind each trade. Instead of waiting for high-quality setups based on technical analysis or a trading plan, they place trades impulsively, hoping that one will eventually be profitable. These trades may be based on gut feelings, news headlines, or random market movements. Compulsive traders rarely stop to assess whether a trade fits their trading system or risk tolerance, and they often make decisions out of sheer habit or emotional impulse. 5. Ignoring risk management. A clear sign of compulsive trading is the complete disregard for risk management rules. Compulsive traders may enter large positions without proper stop-loss orders or position size control. They might ignore the recommended risk-to-reward ratio or fail to assess the amount of capital at risk in each trade. The lack of risk management often leads to huge losses when trades go against them, compounding the emotional distress and reinforcing the cycle of compulsive trading. They may also fail to take profits at appropriate levels, allowing profitable trades to turn into losses as emotions take over. 6. Obsessive focus on the market. Compulsive traders often exhibit an obsessive focus on the market, constantly watching price movements and reacting to every fluctuation. This behavior often goes beyond a normal level of market interest and starts to interfere with their daily life. They may obsessively check charts, news feeds, or trading platforms even when there is no immediate reason to do so. This overengagement can lead to poor decision-making as the trader becomes too caught up in short-term price movements and fails to think strategically. The constant stress of monitoring the market can also take a toll on their mental and physical well-being. Underlying causes of compulsive trading. The root causes of compulsive trading often lie in a combination of psychological factors including 1. Emotional attachment to money. For many traders, money is not just a medium of exchange, it represents security, success, and self-worth. When a trader is emotionally attached to the idea of making money or recovering losses, they become more likely to act impulsively and irrationally. In these cases, compulsive trading is driven by the need to fulfill deeper psychological needs, such as proving one's competence or seeking validation. 2. Fear of missing out, FOMO. FOMO is another major driver of compulsive trading. Traders who feel the need to participate in every market move often experience anxiety when they are not actively involved. This anxiety can lead to impulsive decisions, such as entering a trade based on fear of missing out on potential profits. They may disregard their strategy and jump into trades without fully evaluating the market, believing that they must act before the opportunity passes. 3. Lack of confidence or self-esteem. A lack of confidence can also play a role in compulsive trading. Traders who lack confidence in their trading abilities may engage in excessive trading to prove themselves or to compensate for past mistakes. This behavior may arise from an insecurity about their trading skills or a belief that they are missing out on opportunities. The act of compulsively trading can become an attempt to fill the emotional gap created by self-doubt. 4. Stress and emotional escapism. For some traders, compulsive trading becomes a form of emotional escapism. Stress, anxiety, or dissatisfaction with life outside of trading can drive traders to immerse themselves in the markets as a way of avoiding unpleasant emotions. The short-term thrill of entering a trade or watching the market fluctuate can serve as a temporary distraction from personal problems or negative emotions. However, this pattern only deepens the emotional and financial difficulties in the long run. Strategies for overcoming compulsive trading. 1. Implement a trading plan. The most effective way to combat compulsive trading is to develop and stick to a solid trading plan. This plan should include clear entry and exit criteria as well as well-defined risk management rules. When traders have a plan in place, they are less likely to trade impulsively or based on emotions. The trading plan serves as a guide to help the trader stay focused on their long-term goals and avoid making rash decisions based on short-term feelings. 2. Set strict limits on trades. Traders who tend to overtrade or engage in compulsive trading should set strict limits on the number of trades they make per day or week. These limits should be realistic and align with the trader's strategy, helping them avoid trading out of boredom or impulsiveness. By adhering to a set number of trades, traders can reduce their exposure to unnecessary risks. 3. Take breaks and practice mindfulness. Taking regular breaks from the markets can help to reset emotional equilibrium and prevent compulsive trading. Mindfulness practices such as meditation or journaling can help traders gain greater emotional awareness and avoid acting on impulsive feelings. This mental clarity allows traders to refocus and approach the markets with a more balanced, objective perspective. In conclusion, spotting compulsive trading behavior is crucial for maintaining mental and financial health. Recognizing patterns like trading out of boredom, revenge trading, or ignoring risk management can help traders identify when they are falling into harmful habits. By understanding the underlying psychological triggers and implementing strategies like a structured trading plan, strict limits on trading activity, and regular breaks, traders can regain control over their emotions and avoid the dangers of compulsive trading. Part 3. Strategies to reduce unnecessary trades. Reducing unnecessary trades is essential for maintaining discipline and protecting your trading capital. Many traders fall into the trap of overtrading simply because they feel the urge to be constantly active or because they struggle to control impulses. To counter this, it is important to develop strategies that encourage patience, focus, and adherence to a well-thought-out trading plan. One of the most effective strategies is to establish clear entry and exit criteria before taking any position. When you define the exact conditions under which you will enter or exit a trade, based on technical indicators, price action, or fundamental analysis, you create objective boundaries that limit impulsive decisions. This structure helps ensure that every trade you take is justified by your strategy rather than by emotion or external noise. Another powerful tool to reduce unnecessary trading is to set strict daily or weekly trading limits. These limits can include a maximum number of trades or a cap on the amount of capital you are willing to risk within a certain time frame. By imposing these constraints, you create an environment where you are forced to prioritize quality over quantity. When traders know they have limited opportunities to trade, they tend to be more selective and thoughtful about each trade, which naturally reduces impulsive or random trades. This approach also helps in managing stress and avoiding burnout caused by constantly being glued to the screens. Additionally, incorporating scheduled trading sessions into your routine can be highly beneficial. Instead of watching the markets 24/7 and reacting to every movement, allocate specific blocks of time when you will analyze the market and place trades if conditions meet your criteria. Outside these windows, avoid looking at the charts or market news. This disciplined approach helps break the habit of compulsive monitoring and trading and fosters a healthier balance between trading and other life activities. It also enhances mental clarity, allowing you to approach the market with a fresh perspective during your trading sessions. Another effective strategy is to use trading journals. Keeping a detailed record of every trade, including the rationale behind entering or exiting the trade, emotional state at the time, and the outcome, helps bring awareness to your trading habits. Over time, patterns of unnecessary or impulsive trades will become apparent. Reviewing your journal regularly allows you to identify triggers that lead to overtrading and develop ways to manage or avoid them. This reflective practice promotes accountability and continuous improvement, empowering you to make more disciplined decisions. Furthermore, practicing mindfulness and emotional regulation techniques can significantly reduce unnecessary trades. Techniques such as deep breathing, meditation, or simply taking a moment to pause before entering a trade can help manage the emotional impulses that often lead to overtrading. By becoming more aware of your emotional states, such as anxiety, boredom, or frustration, you can learn to recognize when you are about to trade impulsively and choose to step back instead. Over time, these habits strengthen your impulse control, making you a more patient and rational trader. Finally, surrounding yourself with a supportive trading community or mentor can provide valuable perspective and accountability. Sharing your trading experiences and challenges with others who understand the psychological hurdles of trading helps reduce feelings of isolation and reinforces disciplined behavior. Mentors or peer groups can offer constructive feedback, remind you of your trading plan, and help you stay focused on long-term goals rather than short-term impulses. In summary, reducing unnecessary trades requires a multifaceted approach that combines clear rules, self-discipline, emotional awareness, and support. By defining strict entry criteria, setting trade limits, scheduling focus sessions, keeping a journal, practicing mindfulness, and engaging with a trading community, you create a structured environment that curbs impulsive trading. This not only protects your capital, but also fosters the mental clarity and emotional resilience necessary for consistent success in the Forex markets. Deepening the approach to reducing unnecessary trades. At the core of minimizing unnecessary trades lies the concept of intentional trading, making every trade a conscious decision rather than a reaction to market noise or emotional urges. Intentional trading begins with cultivating a strong mindset grounded in patience and discipline. One way to foster this mindset is through goal setting. Instead of focusing solely on making profits from every trade, set goals related to following your plan, maintaining discipline, and managing risk effectively. When your focus shifts from the outcome of individual trades to the quality of your decision-making process, the urge to enter trades impulsively diminishes naturally. Another often overlooked strategy is the use of automation and alerts to assist in disciplined trading. Automated trading systems or alerts can be programmed to notify you only when specific, predefined criteria are met. This reduces the temptation to watch the markets constantly or enter trades on impulse. By relying on objective signals, you take the emotional component out of the decision-making process, allowing your strategy to guide your trades. Even if you prefer manual trading, alerts can serve as guardrails that keep you aligned with your trading rules. Breaking the habit loop that leads to overtrading is also critical. Habitual overtrading often follows a recognizable pattern, a trigger like a news event or a price spike, followed by the urge to trade, then the action, and finally a reward, which might be the adrenaline rush or the hope of profit. Identifying your personal triggers helps you intervene before the urge turns into action. For example, if checking your trading platform every few minutes triggers impulsive trades, try limiting your screen time or setting fixed intervals to check the markets, replacing the trading reward with a healthier alternative, such as stepping away to do a physical activity, journaling, or practicing breathing exercises, can help break the cycle. Mindset shifts are crucial for long-term change. Understanding that less is more in trading is a powerful realization. The goal isn't to trade often, but to trade well. This shift requires trust in your strategy and acceptance that missing some market moves is part of the game. By embracing the idea that patience is a trader's greatest asset, you reduce the fear of missing out, FOMO, which is one of the main drivers of unnecessary trades. Another practical tip is to review your past trades regularly with a critical eye. Beyond just logging trades, analyze which trades were impulsive and why they occurred. Look for patterns in your behavior. Are you more likely to overtrade after a loss? Do certain times of day or emotional states make you more vulnerable? Use this insight to develop personalized countermeasures. For example, if you notice that you overtrade when feeling stressed, you might schedule trading breaks during high-stress periods or employ relaxation techniques before trading. Incorporating risk management safeguards also acts as a natural brake on unnecessary trading. Setting strict stop-loss levels and limiting the percentage of your account risked per trade forces you to be more selective. When you know that every trade carries a defined and manageable risk, you're less likely to enter trades that don't meet your criteria. This protects your capital and encourages a more measured approach. Finally, recognize the importance of balance and life outside trading. Often, compulsive trading is linked to imbalance in one's lifestyle or emotional state. Engaging in hobbies, physical exercise, social activities, and maintaining a healthy work-life balance can reduce the psychological pressure that pushes traders toward impulsive actions. A well-rounded life provides emotional stability, reduces stress, and ultimately makes you a better, more patient trader. Reducing unnecessary trades is not just about rules. It's about building a comprehensive system that includes mindset, habits, emotional awareness, and lifestyle balance. By adopting intentional trading, using automation wisely, breaking habit loops, embracing patience, analyzing past behavior, enforcing strict risk management, and fostering life balance, you create a robust defense against the urge to overtrade. This holistic approach nurtures the discipline and emotional control needed for consistent success in Forex trading. Chapter 8. Developing Realistic Confidence Through Competence. Realistic confidence in Forex trading is not something that materializes overnight. It is carefully cultivated through dedication, education, experience, and self-awareness. At its core, this confidence stems from genuine competence, a deep understanding of the markets, mastery of trading strategies, and the ability to manage risk effectively. Unlike overconfidence, which is often based on inflated self-belief or isolated successes, realistic confidence is grounded in consistent, repeatable results earned through hard work and continuous improvement. The foundation of competence begins with education. This involves immersing yourself in the study of market fundamentals, technical analysis, and the myriad factors that influence currency movements. Knowledge of how economic indicators, central bank policies, geopolitical events, and market sentiment affect Forex prices builds a framework for making informed decisions. However, education alone isn't enough. True competence requires moving beyond theory to practical application. This means engaging in practice trading, often starting with demo accounts or small positions to test your strategies in real market conditions without risking significant capital. Through repeated practice, traders learn to identify patterns, recognize entry and exit points, and understand how to adjust to different market environments. This hands-on experience refines your skills and builds a sense of familiarity with market behaviors, which in turn fosters confidence. Importantly, competence involves knowing not only when to trade but also when to stay out of the market. Realistic confidence means trusting your analysis enough to wait patiently for optimal setups rather than jumping impulsively into every movement. A crucial aspect of developing competence is embracing risk management as a fundamental part of your trading approach. Competent traders understand that the market is inherently uncertain and that losses are inevitable. What sets confident traders apart is their ability to limit risk exposure through position sizing, stop-loss orders, and diversification so that no single trade can devastate their account. This knowledge empowers traders to approach the market with a calm mindset, reducing fear and emotional reactions. When you know that your risk is controlled, your confidence in making decisions increases because you are not gambling recklessly but making calculated moves. Another vital component is the practice of self-reflection and journaling. Keeping a detailed record of each trade, including your rationale, emotional state, and outcome, is invaluable for developing competence. Regularly reviewing this journal allows you to identify strengths, weaknesses, and recurring mistakes. It helps transform losses from discouraging setbacks into valuable lessons and wins into affirmations of what works. Over time, this process sharpens your decision-making and solidifies your trading methodology. The growing insight and refinement reinforce your confidence, not arrogance, because it's backed by evidence and experience. Developing realistic confidence also means acknowledging your limitations. Even the most skilled traders face unpredictable market events and losing streaks. Competence involves humility, recognizing that you don't have all the answers and that the market will always surprise you. This mindset encourages continuous learning and adaptability, both crucial traits in an ever-changing Forex environment. It prevents the dangerous overconfidence that blinds traders to risk and fuels reckless behavior. Lastly, realistic confidence is about trusting your process rather than seeking constant validation from outcomes. In Forex trading, not every trade will be profitable and the results can sometimes feel random. However, if you follow a tested strategy with sound risk management and maintain discipline, your edge will show over the long term. Confidence comes from believing in this process, even when short-term results fluctuate. This steadiness allows you to make rational decisions under pressure, avoid emotional pitfalls, and remain resilient through losses. In summary, realistic confidence is a byproduct of competence achieved through education, practice, risk management, self-reflection, humility, and trust in your strategy. It empowers traders to approach the market with calm assurance, make thoughtful decisions, and navigate the inevitable ups and downs of Forex trading without succumbing to fear or overconfidence. Part 2. Managing ego and avoiding the know-it-all trap. In the world of Forex trading, ego can be one of the most dangerous psychological pitfalls. It subtly influences decisions, often leading traders down a path of overconfidence and poor judgment. The know-it-all trap is a specific manifestation of ego where a trader begins to believe they have complete mastery over the markets, dismissing new information, alternative viewpoints, or even the inherent uncertainty of trading itself. This mindset can be catastrophic because Forex trading is complex, highly volatile, and influenced by countless external factors that no one can fully predict or control. The trap usually forms after a period of success. A trader may experience a winning streak and start to feel invincible, believing their analysis and instincts are flawless. This can cause a dangerous blind spot where warnings and signals that contradict their view are ignored or rationalized away. For example, a trader might disregard risk management rules like setting stop losses or controlling position size because their ego convinces them that they know better or that the market will reverse in their favor. This false sense of security can lead to catastrophic losses. To avoid this trap, self-awareness is critical. Traders must regularly check in with themselves to evaluate whether their decisions are based on objective analysis or colored by pride and emotion. Reflective questions can help, such as, am I open to changing my opinion if new evidence emerges? Am I trading to prove something to myself or others rather than following a logical plan? Cultivating this habit creates a buffer against impulsive, ego-driven actions. Humility acts as the counterbalance to ego. A humble trader understands that no matter how much experience or success they have, the market is always more complex than any one individual's understanding. They accept that losses and mistakes are inevitable and view them as learning opportunities rather than personal failures. This mindset encourages a growth-oriented attitude where the trader continuously seeks to improve, staying curious and open-minded about new strategies, tools, or market conditions. Another powerful tool in managing ego is seeking external feedback and mentorship. Trading can be isolating, and without a trusted sounding board, it's easy to fall prey to confirmation bias, only seeing information that supports your existing beliefs. Mentors and peers provide reality checks, helping identify blind spots and challenge overconfident assumptions. Constructive criticism from a community or coach not only tempers ego but also accelerates learning and development. Discipline is equally important. Following a predefined trading plan and risk management rules keeps the ego in check by imposing structure and accountability. When traders stick to their plans, such as respecting stop-loss levels, position sizing, and entry criteria, they are less likely to make reckless decisions fueled by pride or stubbornness. Discipline transforms emotional reactions into calculated actions, reducing the likelihood of ego-driven errors. Finally, managing ego requires consistent effort and self-care beyond trading itself. Traders who balance their professional lives with hobbies, physical exercise, and social interactions tend to maintain better emotional equilibrium. This holistic approach reduces the emotional volatility that can inflate ego and impair judgment. In conclusion, managing ego and avoiding the know-it-all trap is a continuous journey that requires humility, self-reflection, openness to learning, disciplined adherence to strategy, and external accountability. Mastering this balance protects traders from the dangerous overconfidence that can erode profits and confidence alike, helping them navigate the unpredictable Forex markets with resilience and wisdom. Part 3. Staying humble in a constantly changing market. In the world of Forex trading, humility is not just a virtue, it's a survival skill. The market is a living, breathing entity that continuously evolves, shaped by global economic shifts, political upheavals, technological advancements, and human psychology. This relentless change means that no matter how much experience or expertise a trader accumulates, the market can always surprise, challenge, and humble them. Traders who recognize this reality and approach the market with humility are far better equipped to navigate its uncertainties and succeed over the long term. Embracing the ever-present uncertainty. At the core of humility in trading is the acceptance of uncertainty. Unlike other professions where outcomes may be more predictable, Forex markets thrive on uncertainty and complexity. Unexpected events, a sudden interest rate hike, geopolitical conflict, or even a tweet can rapidly shift market dynamics. The best traders understand that no strategy is infallible and no prediction is guaranteed. This acceptance frees them from the burden of needing to be right all the time, allowing them instead to focus on managing risk and adapting to new information. By acknowledging that the market is bigger and more powerful than any one individual, traders stay grounded and vigilant. Viewing losses as part of the journey. Losses are inevitable in trading, yet they can often be the hardest lesson in humility. A humble trader reframes losses not as personal failures or evidence of incompetence but as valuable feedback, data points that reveal the limits of their knowledge, expose weaknesses in their strategy, or highlight emotional vulnerabilities. This perspective transforms setbacks into opportunities for growth and learning. Rather than reacting emotionally with frustration or denial, humble traders review their mistakes objectively, analyze what went wrong, and adjust their approach accordingly. This resilience builds mental toughness and helps prevent the self-destructive behaviors often triggered by ego. Cultivating a continuous learning mindset. Humility is inseparable from the attitude of lifelong learning. The Forex market never stops changing, and strategies that once worked may become obsolete as new market regimes emerge. Humble traders maintain a curious and open mindset, seeking out new knowledge and staying informed about global economic trends, technological tools, and behavioral finance insights. They attend webinars, read market analysis, participate in forums, and reflect regularly on their own trading performance. Importantly, they don't view themselves as finished products, but as perpetual students of the market. This dedication to continual improvement keeps their skills sharp and their strategies relevant. Managing ego and emotional balance. One of the greatest challenges in maintaining humility is managing the trader's ego, especially during times of success or failure. After a winning streak, it's tempting to believe that you have figured it all out, which can lead to overconfidence, riskier trades, and careless mistakes. Conversely, after losses, the ego may want to blame external factors or retreat from trading altogether. Humility helps to separate identity from outcome. A trader is not defined by their wins or losses but by their ability to remain consistent, disciplined, and self-aware. This emotional balance prevents the roller coaster of arrogance and despair that can cloud judgment and impair decision-making. Practical habits to foster humility. Humility is not just an abstract ideal, it can be actively cultivated through deliberate practices. Journaling, keeping a detailed journal helps traders document not only the mechanics of each trade but also their thoughts, emotions, and mistakes. This habit promotes self-reflection and helps identify recurring behavioral patterns that need adjustment. Seeking feedback, engaging with mentors, coaches, or peer groups provides external perspectives that challenge blind spots and reduce the risk of falling into confirmation bias. Setting realistic goals, focusing on process-oriented goals such as adherence to risk management, execution of strategies, and psychological discipline, rather than purely financial targets, helps maintain a grounded approach. Regular self-assessment, periodically reviewing performance both quantitatively and qualitatively, keeps traders honest about their strengths and weaknesses. Practicing patience, recognizing that trading success is a marathon, not a sprint, encourages steady, incremental progress rather than reckless attempts at quick gains. The long-term payoff of humility. Ultimately, humility is a strategic advantage. It protects traders from the pitfalls of overconfidence, impulsivity, and emotional volatility. It fosters adaptability, resilience, and continuous growth, qualities that are essential in the fast-paced, unpredictable Forex environment. Humble traders are more likely to survive losing streaks, learn from mistakes, and seize opportunities when market conditions change. They are also more open to innovation and collaboration, enabling them to refine their skills and stay ahead. By staying humble, traders develop a sustainable mindset that balances confidence with caution, ambition with patience, and knowledge with curiosity. This balance is what separates successful traders who thrive over years from those who burn out quickly. In the constantly changing market, humility is not just a moral choice. It's the key to enduring success. Chapter 9. How to bounce back from drawdowns and failure. In Forex trading, drawdowns and failure are not just technical or financial events, they are deeply emotional experiences that challenge a trader's sense of competence, confidence, and purpose. A drawdown, especially a prolonged one, can feel like a personal defeat even when it results from market volatility rather than poor decision-making. This emotional toll can lead to mental fatigue, fear-based decisions, or even a complete loss of motivation. The first critical shift for recovery is embracing emotional neutrality. That means learning to see losses as data rather than self-judgment. Traders must break the connection between outcome and identity. A losing trade does not make someone a bad trader, it simply reflects that either the market conditions changed or an aspect of the strategy needs adjusting. This subtle but powerful shift in mindset is the foundation of psychological resilience. After accepting the reality of the drawdown, the next step is structured post-loss analysis. Emotionally resilient traders use losses as fuel for improvement. They don't just review individual trades, they analyze broader patterns. Did I follow my plan? Was my position size appropriate? Did I act out of fear or impatience? By answering these questions honestly, traders identify whether the failure was due to execution errors, emotional interference, or flawed strategy design. This process turns a losing streak into a learning curve. Crucially, traders must avoid emotional editing where they justify bad trades or ignore warning signs in hindsight. Transparency with oneself is non-negotiable during a recovery phase. Equally important is recalibrating expectations. Many traders fall into the trap of believing that they must quickly make back their losses, which leads to over-leveraging, impulsive trades, and further drawdowns. The truth is that consistent profitability in trading emerges from a high number of properly executed trades, not from heroically recovering in one or two lucky trades. The idea of starting from zero after a loss is powerful. It means resetting psychologically, letting go of the need to recover, and instead, refocusing on executing the next trade with discipline as if the past drawdown never happened. This mindset restores control and reduces performance anxiety. An often overlooked element of recovery is self-compassion. Trading is a mentally demanding pursuit, and being too harsh on oneself can do more harm than good. Self-compassion is not the same as making excuses. It's about acknowledging that trading, like any performance-based profession, involves failure. Professional athletes, surgeons, and entrepreneurs all experience failure. They review, adjust, and return stronger, not because they never fail, but because they don't let failure define them. Traders must learn to talk to themselves the way a good coach would, with honesty, encouragement, and belief in the process. On a practical level, resilience is reinforced by habits and environment. Traders should develop rituals that promote psychological stability, whether that's a daily review journal, a pre-trading meditation session, or strict boundaries about when not to trade, e.g., after 3 consecutive losing days. Even stepping away from the screen for 24 to 48 hours after a tough drawdown can reset the nervous system and allow for a clearer perspective. Creating a physical environment conducive to focus, free from distractions and anxiety triggers, also helps re-establish emotional control. Lastly, recovery from failure is not about bouncing back to where you were, it's about bouncing forward with more awareness. Every setback, when approached correctly, strengthens a trader's edge, not just technically but mentally. The scars of past drawdowns become reminders of lessons learned. Over time, this layered experience creates what truly defines a professional trader. Emotional maturity, strategic clarity, and the confidence to weather storms without losing sight of the long-term horizon. Part 2. Techniques for stress management and focus. Stress in Forex trading is not an occasional inconvenience. It is a constant, built-in feature of the profession. Traders are required to make rapid decisions, often under conditions of uncertainty and financial pressure. Over time, unaddressed stress can silently erode decision-making, increase emotional reactivity, and eventually lead to psychological burnout. That's why learning to manage stress proactively and maintain sharp focus is not optional. It is a survival skill, and like any skill, it can be trained, refined, and strengthened. The first layer of stress management begins with structuring the trader's day. Creating a consistent routine before, during, and after trading provides predictability, which is psychologically stabilizing. For example, a morning ritual that includes reviewing key news events, analyzing charts without rushing, and affirming your trading goals helps set the tone for calm, measured decision-making. Routines reduce randomness, which reduces anxiety. In addition to structure, self-awareness and emotional regulation are critical. The most dangerous decisions in trading are made not when the trader lacks knowledge, but when the trader is unaware of their emotional state. A spike in adrenaline or a wave of frustration can quickly override rational analysis. This is where mindfulness techniques become invaluable. Practicing mindful breathing, even just a few minutes per day, can train the brain to recognize stress signals early. For example, if a trader notices physical cues like increased heart rate, shallow breathing, or muscle tension, these may be early warning signs of emotional strain. Pausing in these moments to engage in deliberate, slow breathing not only calms the nervous system but also breaks the cycle of automatic, emotion-driven responses. Another underutilized tool is the trading break, the intentional stepping away from the screen. Many traders resist this because they fear missing opportunities. However, the reality is that trading while mentally exhausted leads to far greater losses than any missed trade. Implementing short, timed breaks between sessions, say every 60 to 90 minutes, helps reset mental clarity. These breaks can include light movement, hydration, stretching, or stepping outside. These small acts counteract the physiological toll of screen fatigue and decision fatigue, both of which compromise focus and increase stress. Physical health also plays a foundational role in mental sharpness and emotional resilience. Sleep hygiene is especially critical. Chronic sleep deprivation lowers cognitive performance and amplifies emotional volatility. Traders operating on little rest are more prone to overtrading, panic exits, or second-guessing strategies. Similarly, nutrition and hydration influence brain function. A balanced diet that supports energy stability, low in sugar crashes, high in slow-release carbs, and healthy fats, supports consistent mental output throughout the trading day. Even mild dehydration can impair focus and reaction time. Elite traders treat their physical well-being as a performance asset just as athletes do. Another layer of focus-enhancing technique involves information filtering. In the digital age, traders are bombarded by economic news, social media commentary, technical indicators, and real-time price action, creating a cognitive overload that fragments attention and elevates anxiety. Successful traders filter noise ruthlessly. They identify a small number of reliable sources and predefined market signals that align with their strategy and discard the rest. This minimizes distraction and protects their decision-making bandwidth. Many also set up automated alerts for key price levels or events so they don't have to constantly monitor charts. This frees up mental space and prevents fatigue-driven errors. For deeper internal management, traders should consider keeping a detailed trading and emotional journal. This isn't just for recording P&L or setups, it's for tracking emotions, energy levels, confidence, distractions, and clarity. Over time, patterns emerge. Perhaps poor trades tend to follow poor sleep, or losses increase when trades are taken after arguments or stress. Identifying these links allows traders to create custom stress prevention strategies like avoiding trading after emotional events or taking a meditation break before high-impact news. Finally, environmental design and psychological priming play a subtle but powerful role in promoting focus and reducing stress. Traders should aim to create a workspace that is clean, quiet, and optimized for deep focus. This includes good lighting, ergonomic seating, and a distraction-free setup. Many traders also use mental anchors, rituals, or cues that shift the brain into trading mode. This could be as simple as starting the day with a specific piece of music, lighting a candle, or reviewing a list of personal affirmations before the market opens. These rituals condition the mind for performance and help keep stress at bay. In conclusion, managing stress and maintaining focus in trading requires a holistic system. It is a mix of daily rituals, self-awareness, physical maintenance, mental conditioning, and environment control. Together, these practices form a mental armor that not only shields traders from the volatility of the markets but also enhances their clarity, consistency, and longevity in this demanding profession. The most successful traders are not those who avoid stress, but those who know how to master it. Part 3. Building a long-term mindset. Building a long-term mindset in Forex trading is arguably the most critical psychological trait for sustained success. It's easy to become fixated on short-term wins and losses, but doing so can result in impulsive behavior, anxiety, and a skewed sense of accomplishment. A long-term mindset isn't just about having patience, it's about creating a vision, cultivating resilience, and aligning every decision with a bigger purpose. The first step in building a long-term mindset is shifting focus from immediate outcomes to incremental progress. Traders often make the mistake of measuring their success by the results of each individual trade, which can be misleading. The reality of Forex trading is that it's a probabilistic endeavor. No single trade, no matter how well executed, can define a trader's competence. Instead of focusing on the immediate win or loss, successful traders look at their performance over the course of weeks, months, or even years. They define success not by the amount of money made in any given day or week, but by their consistent ability to follow a well-defined plan. This mindset shift allows traders to tolerate losses as part of the natural ebb and flow of the market, reducing stress and the temptation to take reckless risks. A critical component of the long-term mindset is the ability to accept and learn from failure. In Forex trading, there is no such thing as a perfect trader. Even the best traders face losses, drawdowns, and missed opportunities. Rather than viewing these experiences as failures, they are seen as valuable lessons and opportunities for growth. This is where psychological resilience comes in. It's about learning to embrace failure as feedback, viewing each mistake as a stepping stone to improvement rather than a permanent setback. Traders who maintain a long-term view understand that consistent performance is a product of continuous refinement, not instant perfection. Additionally, a long-term mindset is cultivated through continuous self-improvement and education. The Forex market is dynamic, with constant changes in economic conditions, geopolitical events, and market sentiment. Traders who adopt a long-term mindset understand the importance of ongoing learning, whether it's through reading, attending seminars, or collaborating with mentors. The market is ever-changing, and the ability to adapt to new information is vital for survival. By committing to lifelong education, traders can stay ahead of the curve and refine their strategies as the market evolves. Risk management is another foundational pillar of a long-term mindset. In the short term, it may seem frustrating to set tight stop losses or risk a small percentage of capital per trade, especially when the market appears to offer quick profits. But traders with a long-term mindset understand the importance of protecting their capital to ensure they can trade another day. Capital preservation is a key to staying in the game, and even in the face of losses, these traders continue to operate with a sense of discipline, always mindful of their broader goals. By managing risk effectively and taking a long-term view of capital growth, traders can ensure they are in the market for the long haul. Additionally, avoiding the get-rich-quick mentality is a crucial part of building a sustainable mindset. In Forex, the desire for immediate success can lead to hasty decisions, over-leveraging, and trading impulsively to make up for past losses. The long-term trader understands that wealth in Forex doesn't come overnight. It's built slowly through calculated decisions, consistent execution, and the application of well-researched strategies. This mindset requires the ability to say no to the tempting fast money trades and instead focus on steady, calculated risk-taking that aligns with the trader's broader objectives. Building a long-term mindset also involves developing an emotional detachment from profits and losses. While it's natural to feel a rush of euphoria after a successful trade, or conversely, frustration after a loss, successful traders don't let these emotions drive their actions. They learn to maintain equanimity, the ability to remain emotionally stable regardless of market conditions. This emotional detachment helps traders avoid the emotional roller coaster that can derail decision-making and cloud judgment. It also encourages a healthier relationship with money where financial gain or loss becomes a byproduct of sound decision-making rather than an end in itself. In practical terms, cultivating a long-term mindset often involves setting clear, long-term goals. Traders should establish both financial and non-financial goals, such as becoming a consistent, disciplined trader or improving their strategy over a set period. These goals act as a compass, guiding decisions and helping traders stay focused on what truly matters. It's important to break down long-term goals into smaller, actionable steps, which allows traders to track progress and stay motivated, even in times of drawdown or stagnation. Lastly, traders must be prepared for the psychological toll that the markets can have over the long term. The stress and volatility of Forex trading can take its toll on mental health, so maintaining balance is essential. Building a support system, whether through peer groups, mentors, or even psychological counseling, is crucial for dealing with the mental strain that can come with the profession. Traders who embrace a long-term mindset understand that their journey is not just about mastering the markets, but also mastering themselves, developing emotional intelligence, mental discipline, and a balanced approach to work and life. In conclusion, building a long-term mindset in Forex trading is about cultivating resilience, patience, continuous learning, risk management, and emotional detachment from short-term fluctuations. It is not simply about weathering the storm, but about becoming the type of trader who thrives through the storm, adapting and improving with every challenge. When traders adopt this mindset, they stop focusing on the immediate outcomes of individual trades and start focusing on the bigger picture, the long-term, sustainable growth of their trading career. This mindset allows traders to stay grounded in the face of adversity, to view each setback as an opportunity to learn, and to focus on the steady accumulation of skills, knowledge, and capital. One trade at a time. Chapter 10. The Zen of Trading. The concept of trading in the zone, mastering flow, focus, and emotional clarity in the market. The phrase trading in the zone represents more than just being in a good mood or having a lucky streak. It's a profound psychological state of peak performance where the trader is operating with unshakable focus, complete presence, and emotional detachment. This concept, originally popularized by trading psychologist Mark Douglas, describes a mental state in which a trader becomes so immersed in their process that decision-making becomes fluid, automatic, and unbiased by fear, greed, or ego. It's where logic and intuition harmonize and every action feels natural, executed not out of impulse, but out of trust in preparation, repetition, and self-control. To trade in the zone is to be completely aligned with the market's movement, not trying to force trades, not fighting the trend, and not overanalyzing every candle. It's a state of mental clarity where the trader is unaffected by the outcome of a single trade because they are focused on the process, not the result. In this zone, the trader is fully present. The past, a missed setup or a losing trade, and the future, the profit target or financial goal, fade into the background. There is only the now, this chart, this setup, this signal. That present moment awareness is what gives the trader a sense of calm authority, even in fast-moving markets. Getting into this state requires mental discipline and emotional conditioning, not just technical skill. Most traders carry invisible emotional baggage into their trading: the desire to prove themselves, the fear of being wrong, the urge to recover losses, or the pressure to perform. These mental weights disrupt decision-making, creating hesitation, anxiety, or impulsive reactions. The trader who learns to let go of these attachments and instead cultivates a neutral, focused mindset begins to tap into the zone more consistently. This is the psychological edge that few talk about, but that separates professionals from the emotionally reactive crowd. At the core of trading in the zone is trust in your trading system, trust in your edge, and trust in your own ability to execute without hesitation. Traders in the zone don't obsess over each pip or micromanage their trades. They've done the work ahead of time, their strategy is defined, their risk parameters are clear, and their mindset is grounded. Because they trust the system they've refined, they allow the process to unfold without emotional interference. They don't ask, will this trade win? They ask, is this a valid setup? That shift in focus from outcome to execution is what allows the brain to remain calm and engaged rather than scattered and reactive. Another defining characteristic of trading in the zone is the presence of flow, a concept from performance psychology that describes a state of complete immersion in an activity. In flow, time seems to slow down or disappear. The trader becomes so engaged with the market that external distractions lose their power. Decisions arise naturally with clarity and precision. There's no second guessing, no forced trades, no hesitation. This is not accidental, it's the result of a finely tuned process, emotional detachment, and deep familiarity with one's own behavior under stress. In this state, the trader becomes less like a gambler and more like an artist or athlete, fully present, fully engaged, fully aligned with their craft. But perhaps the most powerful element of trading in the zone is its emotional neutrality. The zone is not an emotional high, it's not about feeling euphoric or invincible. It's about calm awareness. In this state, a win doesn't inflate the ego, and a loss doesn't destroy confidence. The trader is balanced, objective, and unaffected by short-term outcomes. This neutrality is what allows them to stay consistent and rational, even after a string of losses or during volatile market events. There is no desperation, no greed, no fear, just the calm application of a trusted process. In essence, trading in the zone is the embodiment of trading mastery, not perfection but presence. It is not a place you stumble into by accident, but a mental space you can train for by building emotional awareness, refining your system, eliminating mental clutter, and committing to process over outcome. When a trader enters this state, they're no longer trading against the market or their emotions. They're moving with the flow of both. That is the true zen of trading. Part 2. Letting go of the outcome, mastering detachment to strengthen discipline and clarity. One of the most profound shifts a trader can make on their journey to mastery is learning to let go of the outcome. This concept, central to both Zen philosophy and elite performance psychology, requires traders to separate their self-worth and decision-making from the results of any single trade. In practice, this means no longer tying your emotional state to whether a trade wins or loses, but instead finding fulfillment in the quality of your process, your discipline, and your ability to execute with integrity. Letting go of the outcome does not mean not caring about results. It means caring more about how you trade than how much you make. In Forex trading, the future is always uncertain. Every trade, no matter how well planned, carries risk. When traders fixate on outcomes, how much profit they'll make, whether this trade will be the big one or how fast they can recover from a loss, they become emotionally entangled in the result. This attachment often leads to poor risk decisions, moving stop losses, over-leveraging, exiting early, or revenge trading. Ironically, the harder a trader tries to control the outcome, the more likely they are to sabotage their own consistency. Detachment, on the other hand, creates mental freedom, freedom from fear, greed, and the destructive pressure to be right. Letting go of the outcome begins with reframing how success is defined. Rather than viewing a winning trade as a success and a losing trade as a failure, the Zen trader views success as sticking to their plan, managing risk properly, and executing with discipline. In this mindset, even a losing trade can be a victory if it was executed correctly and in alignment with the rules. This detachment allows the trader to judge performance by consistency and process, not just short-term results. It reinforces a key truth. Trading is a game of probabilities, not guarantees, and good decisions can still lead to losing trades, just as bad decisions can occasionally result in profit. To let go of the outcome, a trader must also detach their identity from their P&L, profit and loss. Many traders subconsciously see a win as proof of their intelligence or skill, and a loss as a reflection of personal failure. This ego-driven perspective creates an emotional roller coaster and leads to erratic behavior. True trading maturity comes from understanding that results are impersonal. They are the byproduct of probabilities playing out over time. The market does not care who you are, how badly you want to win, or how hard you try to force a result. Recognizing this allows a trader to move from ego-driven trading to principle-driven trading. One of the most powerful tools to develop this mindset is pre-trade detachment. Before entering a position, a Zen trader mentally accepts both possibilities, gain or loss. They define the risk clearly, accept it as spent capital like a business expense, and release emotional investment in the trade's result. This mental preparation allows them to remain calm and focused once the trade is active. They aren't watching every tick with anxiety or fantasizing about the potential reward. They are observing, managing, and adjusting if needed, but always from a centered place. If the trade hits the stop, it's simply part of the plan. If it hits the target, it's the result of discipline, not luck or desperation. Letting go also means giving up the illusion of control. Traders who cling to certainty, who want to predict exactly what will happen, often struggle the most. In reality, success in trading doesn't come from knowing what will happen next, but from having a structured plan for what you will do when the market moves, regardless of direction. The Zen trader embraces uncertainty. They know they can't control the market, but they can control their preparation, their risk, and their response. That shift in focus from outcome to controllable actions is where true power lies. Ultimately, letting go of the outcome is about finding peace within the process. It's trading not to chase money or feed ego, but to engage with the market as a craft, to execute with focus, to learn continuously, and to grow into a more centered, self-aware individual. In this way, trading becomes not just a financial pursuit, but a path of personal evolution. And when the trader truly detaches from the need for a specific result, they begin to trade from a place of freedom, clarity, and confidence, the very essence of the Zen state. Part 3. Cultivating mindfulness and emotional detachment. Cultivating mindfulness and emotional detachment. The trader's path to inner stillness and clear decision-making. In the world of Forex trading, where unpredictability is constant and emotional pressure is high, mindfulness and emotional detachment are not luxuries. They are necessities. While most traders spend years refining indicators, testing strategies, and analyzing price action, few dedicate enough time to training the mind behind the execution. Yet it is this mind, the seat of perception, emotion, and decision, that ultimately determines success or failure. Mastering it begins with mindfulness. Mindfulness, in its simplest form, means present moment awareness without judgment. In trading, it is the ability to observe what is happening right now, both in the markets and within yourself, without reacting impulsively or emotionally. It allows you to become an objective observer rather than a reactive participant. When a trader is mindful, they are aware of their breathing, their posture, their thoughts, their emotional state, and the live price all at once with calm presence. They are not lost in the past trade that went wrong or fantasizing about the next big win. They are simply here, with the market engaged, steady, and free from internal noise. On the other hand, emotional detachment means letting go of the need to control, predict, or force outcomes. It's the mental discipline to say, I don't need this trade to work out in order to feel okay. It is freedom from being emotionally bound to wins and losses. It's the difference between trading to trade well versus trading to feel good. When you trade with emotional detachment, you accept risk, accept uncertainty, and let go of ego-based expectations. This doesn't mean you don't care. It means you've matured beyond caring in the wrong ways. Together, mindfulness and detachment allow you to operate from a space of clarity. You become less reactive to market fluctuations and more aligned with your trading plan. A spike in volatility doesn't cause panic. A winning streak doesn't lead to overconfidence. A losing trade doesn't shatter your confidence. You begin to see your emotions not as truth, but as weather passing clouds across the sky of your awareness. You don't resist them, but you don't follow them either. Practical tools to develop mindfulness in trading. 1. Pre-trade centering rituals. Before placing your first trade of the day, take 2 to 5 minutes to sit quietly. Close your eyes. Breathe deeply in through the nose, out through the mouth. Feel the chair beneath you. Let go of distractions. Set an intention. Today, I will trade with patience and clarity. This simple ritual grounds you and helps establish psychological readiness. 2. Emotional labeling during trades. As you observe yourself throughout the trading session, mentally note your feelings without judgment. I'm feeling anxious. I'm experiencing FOMO. I want to chase. This act of labeling creates space between you and the emotion, reducing its power to hijack your behavior. 3. Mindful journaling. After each trade or session, write not only what you did, but how you felt. What were you thinking? Were you calm or reactive? Did you act out of alignment with your plan? Over time, this builds emotional awareness and patterns start to emerge, helping you understand and regulate your mental habits. 4. Visual cues and reminders. Place a sticky note on your screen with reminders like, "Oh, breathe. Oh, trade the plan, not your emotions. Oh, the next 100 trades matter more than this one." These cues interrupt compulsive behavior and re-anchor you in the present moment. Cultivating emotional detachment through philosophy. To truly detach, traders must internalize one of the deepest truths in trading: the market owes you nothing. It doesn't reward hard work, punish laziness, or behave rationally. It is not fair or predictable, it is simply unfolding. When traders accept this, they stop trying to force the market to meet their expectations. They trade what is actually happening, not what they wish would happen. This is emotional liberation. Another key philosophical shift involves separating self-worth from performance. You are not your P&L. A bad trade doesn't mean you're a bad trader. A string of wins doesn't make you invincible. This kind of detachment requires deep self-awareness and often mirrors personal growth. Many traders who master this area report improvements not only in trading but in relationships, communication, and life satisfaction. The mindful trader's mindset. I am committed to the process, not the outcome. I accept uncertainty as part of the journey. I respond to the market. I do not chase it. I watch my emotions, but I do not become them. I trust the edge. I respect the risk. I release the result. With this mindset, the trader becomes more than a speculator. They become a practitioner of discipline, patience, and presence. Their charts become a mirror not only of the market but of their internal world. Each trade becomes an opportunity to practice mastery, not just of price, but of self. In conclusion, cultivating mindfulness and emotional detachment is the final layer of psychological mastery in Forex trading. It transforms the trader from a reactive participant into a deliberate performer, someone who can calmly navigate chaos and uncertainty with grace. It is the embodiment of Zen, being present without attachment, engaged without obsession, and consistent without needing control. When you trade from this state, you don't just trade better, you live better. Because the discipline that builds mindfulness on the charts becomes the same discipline that brings balance and clarity off the charts. Bonus points. Daily Trader's Journal Template. Daily Trader's Journal Template. A foundation for growth and clarity. Keeping a detailed trader's journal is one of the most powerful habits a Forex trader can develop. It acts as both a mirror and a guide, reflecting your emotional and mental state alongside your technical decisions, and helping you identify patterns that lead to success or failure. Far beyond just recording wins and losses, a well-structured journal deepens self-awareness, sharpens discipline, and anchors you in the present moment, which is crucial for consistent trading. Start each trading day with a morning prep section. This pre-market entry is a chance to pause and mentally prepare, setting the tone before the market's fast pace takes over. Begin by honestly noting your emotional state. Are you feeling calm, stressed, excited, or distracted? Recognizing your mindset before trading can help prevent impulsive decisions driven by unacknowledged feelings. Next, clearly outline your key intentions for the session, such as following your stop-loss rules, avoiding revenge trades, or waiting patiently for high-quality setups. Writing down your goals creates a psychological contract with yourself, reinforcing discipline. Additionally, make a brief note of the broader market conditions, whether trends are strong or the market seems indecisive, and any major news events that could cause volatility. Finally, include a personal affirmation or reminder, such as, "I trade with patience and clarity," to anchor your mindset and focus your energy. During the trading session itself, use your journal to capture real-time awareness. Record the time and details of each trade, including which strategy you used and how you graded the setup, for example, A, B, or C quality. This assessment forces you to objectively evaluate your trade entries rather than relying on hindsight bias. Importantly, document your emotions before and during the trade. Were you feeling confident, anxious, or rushed? Noticing these emotional cues helps to uncover subconscious drivers of behavior that can impact performance. Note whether you followed your plan fully or deviated, and reflect briefly on what you did well and what could be improved. This step fosters a growth mindset by encouraging constructive feedback rather than self-criticism. At the end of the day, the post-market reflection section offers a broader perspective. Summarize the total number of trades taken and break down the wins and losses to identify any trends or anomalies. Reflect on emotional highs and lows experienced throughout the day, highlighting moments where impulsive urges arose and whether you managed to resist them. This reflection builds emotional resilience and improves impulse control over time. Conclude by identifying your biggest takeaway from the day, whether a technical insight, psychological breakthrough, or behavioral lesson, and set a clear focus for tomorrow. This ongoing cycle of preparation, awareness, and reflection forms the cornerstone of continuous improvement. By maintaining this daily journal, you transform trading from a reactive pastime into a deliberate practice. You cultivate mindfulness by frequently checking in on your emotional and mental state. You build discipline by holding yourself accountable to your plan and intentions. And you develop competence by learning from your own recorded experiences instead of guesswork. Over time, this disciplined journaling becomes a personalized roadmap guiding you steadily toward greater consistency, confidence, and psychological mastery in Forex trading. Part 2. Top 10 Mindset Hacks for Traders Cultivating the Mental Edge. In Forex trading, technical skills and strategies are critical, but it is the mindset that often distinguishes consistently successful traders from the rest. Developing the right mental habits can protect you from costly mistakes and empower you to navigate the emotional roller coaster of the markets with clarity and control. The following top 10 mindset hacks are practical, actionable tools designed to sharpen your psychological edge and improve your trading outcomes. First, breathing before every trade is deceptively simple but profoundly effective. When markets move fast, it's easy to become overwhelmed by adrenaline or anxiety, leading to rushed decisions. Taking even a single deep breath resets your nervous system, reduces stress hormones, and centers your mind. This brief pause creates space to re-engage with calm focus rather than reactive impulse, setting the stage for better decision-making. Next, view each trade as one of the next 100 helps reduce emotional attachment to any single position. It's common for traders to become fixated on winning or losing a particular trade, but this perspective encourages a long-term mindset. By focusing on a series of trades rather than individual outcomes, you reduce pressure and emotional highs and lows, fostering steadier, more rational behavior. A third key habit is to ask yourself, what's my role right now? Many traders lose focus because they confuse their priorities. If you are in execution mode, your role is to follow your plan calmly. If you're reviewing charts, your role is to analyze objectively. If neither, step away. This simple question keeps you anchored in the present task, preventing distractions and emotional drift. Using mantras is another powerful psychological hack. Repeating short phrases like process over outcome, I trade my edge, or detach from results helps reprogram your mind during moments of stress or temptation. Mantras act as mental anchors, redirecting attention to discipline and reinforcing your trading philosophy when emotions run high. Trading when emotionally charged is a common pitfall. Anger, excitement, or fatigue can cloud judgment and lead to impulsive decisions. One of the best mindset hacks is to simply walk away when feeling overwhelmed. A break refreshes your mind, breaks the cycle of emotional reactivity, and preserves your capital for better opportunities. A sixth hack is to zoom out on both the chart and your goals regularly. Instead of obsessing over small price movements or recent trades, step back and review longer-term trends and overall performance. This broader perspective reduces anxiety and helps maintain confidence by reminding you of the bigger picture, progress, and plan. Celebrating process, not profits, shifts your reward system from outcome-based validation to habit-based reinforcement. By rewarding yourself for following your trading plan, maintaining discipline, or executing well, even in a losing session, you build intrinsic motivation and resilience. This approach reduces the emotional roller coaster tied to wins and losses. Another valuable technique is to use the power of pauses throughout your trading day. Even taking 10 seconds to breathe, stretch, or reflect between trades can interrupt automatic, impulsive behavior. Pauses help you reset, evaluate whether you are still aligned with your plan, and maintain emotional equilibrium. Pre-planning your response to losses prevents revenge trading and emotional spirals. Decide ahead of time how you will react to a losing streak, whether that's stepping away, reviewing trades calmly, or journaling your emotions. This preparation transforms losses from moments of chaos into opportunities for measured reflection and growth. Finally, visualizing your best trading self daily is a mental rehearsal technique that prepares you psychologically for peak performance. Imagine yourself waiting patiently for high-quality setups, executing trades calmly, and accepting results without attachment. This mental practice helps align your subconscious habits with your conscious goals, making disciplined trading more natural and automatic. Integrating these mindset hacks into your daily routine cultivates emotional intelligence, self-control, and focus, qualities that separate successful traders from those who struggle. Over time, these small shifts build a resilient mental framework that can handle the pressures of Forex markets, reduce costly mistakes, and ultimately enhance your profitability and longevity as a trader. Part 3. Interview snippets with successful FX traders, deep insights into the trading mindset. Learning from those who have walked the path before you is one of the most effective ways to accelerate your own development as a Forex trader. Successful FX traders often share common psychological traits and practices that underpin their long-term success, and their personal stories provide both inspiration and practical guidance. Below are extended reflections gathered from interviews with seasoned traders, offering a window into the mental frameworks and emotional disciplines that help them thrive amid the challenges of the Forex market. A pivotal insight many traders emphasize is the importance of accepting the inherent uncertainty and lack of control over the market. One experienced trader explained, "In the early days, I believed if I just worked harder and analyzed more data, I could predict market moves perfectly. This illusion of control created immense pressure and led to frustration when things didn't go as planned. It took me years to understand that the market is fundamentally unpredictable and that my job is to manage my responses, not the market." This mindset shift freed me emotionally and improved my trading discipline. This acceptance isn't passive resignation but an empowering recognition that frees traders to focus on what they can influence. Risk management, trade execution, and emotional control. Another recurring theme is how traders cope with losing streaks and setbacks, which are inevitable in any trading career. One professional shared, "When I hit a string of losses, it's easy to feel defeated and want to get even with the market. Early on, I would chase trades impulsively to try to recover losses, which only made things worse. Over time, I developed a routine. I stopped trading when emotions run high, step back to review my trades objectively, and remind myself that losses are part of the game, not a reflection of my skill or worth. This mental reset helps me maintain perspective and return with a clear plan and calm mindset. This approach underscores the importance of emotional self-care, structured reflection, and cultivating patience during tough periods. Discipline emerges as a central pillar in these conversations. One trader distilled discipline down to consistency and trust. Discipline means sticking to your plan day after day even when the market is dull or when you feel impatient or fearful. It's not about excitement or passion in the moment, it's about honoring your edge and maintaining your process despite the emotional ups and downs. Discipline is what separates amateurs from professionals. This viewpoint reframes discipline as a sustained commitment to routine and process rather than momentary bursts of willpower or motivation. Humility and the willingness to keep learning also stand out as crucial psychological traits. As one veteran trader put it, no matter how many years I've been trading, the market always surprises me. If I become overconfident, I make mistakes. Staying humble means accepting that I don't have all the answers and being open to new information and adapting my strategies. It keeps me alert and flexible, which is essential in a constantly evolving market. This humility guards against the know-it-all trap and encourages a growth mindset, which fosters resilience and adaptability. Finally, many traders credit journaling and self-awareness as foundational tools for psychological growth. One interviewee noted, "My journal is more than a record of trades, it's a diary of my emotional and mental state. By reviewing it regularly, I identify patterns, times when I'm prone to emotional trading, specific triggers that lead to mistakes, and how I recover from losses. This insight has helped me develop strategies to manage my emotions and refine my trading habits. Without journaling, I'd be flying blind." The practice of journaling thus becomes a feedback loop, helping traders move from reactive to reflective, improving both mindset and performance over time. By sharing these real experiences, successful traders illuminate the psychological landscape of Forex trading. Their stories validate the common struggles and offer practical tools for managing emotions, fostering discipline, and maintaining humility. These insights not only humanize the challenges but also empower aspiring traders to approach the market with realistic expectations, emotional resilience, and a clear framework for continuous improvement. Part 4. Guided Meditation for Pre-Market Prep. Guided Meditation for Pre-Market Preparation, Building a Mental Fortress for Trading Success. The world of Forex trading is fast-paced and emotionally charged, often demanding split-second decisions under intense pressure. One of the most effective yet underutilized tools for maintaining mental clarity and emotional stability is guided meditation, especially when practiced before the market opens. A structured meditation routine primes the mind to enter a state of calm awareness, enhances focus, and reduces the psychological pitfalls that frequently sabotage trading performance, such as anxiety, impatience, and impulsivity. A well-designed pre-market meditation session typically starts with deep breathing exercises, which play a crucial role in calming the nervous system. When traders are stressed, their breathing tends to become shallow and rapid, triggering the sympathetic fight or flight response. This physiological state impairs judgment and heightens emotional reactivity. By intentionally slowing and deepening the breath, meditation activates the parasympathetic nervous system, reducing heart rate and blood pressure, and creating a physical foundation for calmness. This simple act of breath control creates a physiological shift from tension to relaxation, preparing the trader's mind for focused, rational decision-making. Once the body is settled, the meditation guides the trader to center their awareness in the present moment. Mindfulness, the ability to observe thoughts and sensations without judgment, is cultivated to help traders disengage from distracting worries about past losses or future uncertainties. Instead of being overwhelmed by what-ifs or regret, the trader learns to acknowledge these thoughts as fleeting mental events, gently returning focus to the here and now. This practice builds emotional resilience by breaking the cycle of negative rumination and helping the trader maintain equanimity amidst market volatility. A powerful component of the meditation is the use of visualization techniques. Traders are encouraged to mentally rehearse entering the trading day with a composed and confident mindset. This visualization often includes picturing themselves calmly executing their trading plan, patiently waiting for the right setups, and responding to winning or losing trades without emotional disturbance. Visualizing success in this way aligns the subconscious mind with the conscious intention to trade with discipline and control, reinforcing constructive neural pathways that reduce impulsive, emotionally driven decisions. In addition to visualization, the meditation may incorporate positive affirmations tailored to the trader's psychological needs. Statements such as "I am focused and disciplined," "I accept uncertainty as part of the game," or "I trade with clarity and calm" help reprogram limiting beliefs and combat detrimental self-talk. Affirmations serve as mental anchors during the day, reminding traders to return to their core values and strategies despite emotional turbulence. Importantly, guided meditation also fosters emotional detachment, enabling traders to view outcomes objectively without attaching their self-worth or happiness to profits or losses. This detachment is critical for consistent trading because it prevents fear and greed from dictating decisions. The meditation trains the mind to see trades as opportunities to follow a process rather than as personal victories or failures, reducing stress and supporting long-term success. Regularly incorporating a pre-market meditation routine can transform how traders approach their craft. Beyond immediate benefits of increased focus and reduced anxiety, the practice cultivates a long-term psychological foundation, strengthening patience, sharpening concentration, and fostering a balanced perspective. Over time, traders become better equipped to handle the emotional highs and lows of the markets, make clearer decisions, and maintain consistency. In essence, guided meditation serves as a mental fitness regimen essential for anyone serious about mastering the psychological demands of Forex trading. Thank you for listening to The Psychology Code, Unlocking Forex Trading Mastery. Remember, success in Forex trading is not just about strategy or analysis, it's about mastering yourself. The insights and techniques shared here are designed to help you build mental resilience, discipline, and clarity in the face of market chaos. Apply these principles with patience and persistence and watch as your trading transforms from reactive to intentional. If you found this audiobook valuable, please like, subscribe, and share it with fellow traders who want to elevate their mindset and performance. Until next time, trade smart, stay disciplined, and keep unlocking the power of your mind.